And the payments business out of the Netherlands, net revenue beating, customers spending, that's on the rise. Apparently that does well for the business, and I've seen some calls higher for that particular company.
I mean, it's interesting because it's coming, again, on the back of the Astra story, the Caring story, the Immerse story. 3 different companies, all seemingly quite weak.
I can't believe that I've become the Taylor Swift Gucci correspondent, but anyway, that seems to be the new narrative. European markets are open. I don't think you're going to expect fireworks at the get-go this morning. I think you're going to see a FTSE that is going to struggle in and out of positive territory, which is exactly what we're getting. So the FTSE at the moment, absolutely unchanged. You've got to plug Anglo in as well to that story as well this morning. The corporate news, though, I don't know, on balance, just feels underwhelming.
There we go. Let's go to Maersk. Maersk shares in open auction extension in Copenhagen. So it seems as if there might be a bit of volume trying to go through that one. And we've just talked about some of the negatives in that conversation, because in the short term, as we mentioned, the pricing moves favourably and they're able to benefit. But having to sail that long way around for an indeterminate amount of time, perhaps longer than people had anticipated, certainly painting a picture of things escalating, not calming down. That is certainly something we're watching this morning.
And let's talk about one of the biggest index contributors it seems this morning. It's Unilever, making up a good chunk. I mean, very opening prices. We're still waiting for this to all shake out. But Unilever coming out with numbers that I thought were on par with the expectations. So I'm curious what the folks are responding to.
So Francina's been talking to the CEO. We'll get that interview to you very, very shortly. We're going to take on exactly what is happening there, what's surprising, what's positive out of this. Astra, those are drag. That's the biggest points drag so far. So AstraZeneca, I asked Pascal Soriot, which would he focus on right now? Would it be that core EPS miss, or would it be the guidance? I think the market's maybe made up its minds. It's that core line that I think is frightening people this morning.
Yeah, healthcare is the worst performing sector so far this morning. We see a host of names in that sector moving weaker. AstraZeneca is one of them, down by 1.2%. At this point. Personal consumer discretionary is the best performer. You made this point already, Kritty, around Unilever, and that stock up by 3.3%. So that's the other side. So 2 earnings stories going in opposite directions.
Alongside LVMH, which is weird.
Because it's got a downgrade, hasn't it?
LVMH does. Caring does.
I think we've seen downgrades coming through. My timing might be wrong on this, so if you just check out the MC line. But Caring looks like it's reacting positively. I'm just going into the French market. In terms of the biggest points gains there, you've got LVMH up by 0.5%, but Caring is up by 3.3.
Yeah, which isn't bad on a day where the guidance wasn't great, and they're talking about things like being determined to make short-term pain pay off in the future. There's a turnaround happening, so maybe the market has seen something in that.
Yeah, I mean, a real strategy that even just initially, it looks like the CEO is coming out and talking about, saying that for Gucci, they're planning to curb availability on some of those items. So again, already trying to perhaps play a little bit of the demand-supply story, and the one that's going to have an immediate effect, it seems.
So Immerse has done this really well. So Immerse is top end. You can't get. They're sold out for ages.
Guys, been waiting years.
I've been waiting precisely, absolutely years
for
my Birkin bag.
Is that what's happening? Yeah.
You can't get them for love nor money. You have to get on the wait list. It's a real challenge, but it's really worked for them. That exclusivity. Veblen goods, you think about them, they're goods that basically, the higher the price, the scarcity value.
Oh my God, did you just pull up Eco 101?
We've just gone back to high school economics.
But these are the perfect examples of them.
Just when I thought you were the George Clooney of Bloomberg, you turned out to be the nerd of Bloomberg.
Both can be true.
Yeah,
it's true.
You're worried about, I'm not going to take your title. You're fine. Maria, I need to get this right. So Vaitmana. There we go. Maria Vaitmana, Head of Equity Research at State Street Global Markets, joins us now. We've been talking to Maria for years, and we continue to pronounce her name wrong, which is why I want to make sure that we get it right this time round. Nice to see you. Good morning. Look, give us your take on the European earnings story thus far. It feels to me like it's not going as well as many people have anticipated, and the anticipation was already pretty low.
Yeah, good morning, and thank you very much for trying to pronounce my name. I think like our take on earnings season, it's kind of underwhelming. I think you kind of use that word as well. Earnings expectations have been coming down ahead of earnings, so expectations are not great, and companies just barely kind of make them on average. But the big concern for us is margins. So lots and lots of companies talking about the need, in order to generate stronger revenues to get kind of to the target, they need to give discounts, and the costs are rising, and margins are really getting squeezed. To me, that's really the biggest concern, because I mean, earnings expectation further out next year and kind of the big the soft landing story really hinges on this idea that earnings will recover in the second half of the year, and year-on-year growth for 2024 is double digits. So how are we going to achieve that? I mean, I keep harping on that Europe is in recession and its sales growth would be problematic, but if margins are falling, that would be even more difficult. So to me, margins is really a concern, and don't see a lot of kind of evidence to say that actually we're fine.
Can I ask you about what's been driving sentiment of late? US tech, we talked about this at the top of the program, about the ARM numbers last night. And I ask you about this because, you know, we've got the S&P at a record near that 5,000 mark. What concerns you about tech? Is it that you're worried that there's an AI bubble, or do you think they're just vulnerable to a change in thinking around Fed cuts? What is it that worries you about the tech space?
Well, Anna, you know me, I love tech, love tech. That's been my favorite sector for many years. And yes, it is expensive. Yes, it is crowded. So arguably, I mean, valuations are high, but companies are so profitable. And what else? The other thing I really love about tech is their huge balance sheets. So we know that when financial conditions are tight, recession is coming, really the channel of kind of transmission of Fed policy is through higher interest rates, lower demand. That's potentially where tech is safe. They have huge balance sheets, they have cash on their balance sheets, they're actually making money or of higher interest rate other than the interest expense going up. And the demand for their product is still strong, and AI keep capturing market's imagination, so earnings are okay, margins are fine, and that's, I mean, a huge contrast with the rest of the market. I mean, I keep quoting the statistics that Q4 earnings growth in tech is plus 40%. Q4 earnings growth in S&P 494 is minus 10%. So if you believe that economy is slowing, earnings are coming down, you have to pay higher margins for those growth companies.
Maria, talk to us a little bit about this divergence that we're seeing in the market. It's been a theme that Guyana and I have been discussing all week long, where we're seeing these buyback increases, these dividends across sectors, Maersk excluded from that story, of course. But is that reflective of the actual fundamentals when we look at this market reaction?
I think companies are desperate to kind of keep their investor base, and particularly like companies that traditionally pay dividends, they're desperate to stay with that and kind of flex the muscle and demonstrate they have strong financial health and maintain dividends and pay dividends when they can. And that really differentiates the do's from the don'ts. So yeah, dividends, I suspect it's more kind of signaling and potentially, okay, well, where else we're going to put our money? But if you have return to investors, that tend to be really rewarded. So I think you're right. It's a strong theme, and it's have very kind of powerful signaling mechanism.
Maria, do I need to get ready to buy China?
Depends on your investment horizon. If you are a day in, day out trader, I think now we see lots of kind of positive news. I'm really skeptical about long-term case there, because the policies that kind of recently announced, they're all targeted to the market, stock market. So we get rid of short selling, we get ETF buying, we kind of increase ours, but not all of them, and it will take a long time to address the key reason why investors are underweight China. And by the way, investors have huge underweight in Chinese stocks, international investors, and really not coming back at force. Well, that's economic growth. China is slowing. That's kind of falling savings rates. That's property markets still not being resolved. So kind of those kind of low profitability in corporates, that has not been resolved. And secondly, I don't know, do you want to be in a market which kind of short-term fortunes are really resolved around this, or will regulators help me today, or will it give with one hand and take away with another hand? So this kind of regulatory uncertainty, I mean, it feels like now winds are kind of supporting, but I mean, we know that it's oftentimes been fairly arbitrary. It goes in and goes out. So to me, it's about underlying corporate profitability, and that's just not there. And the measures that's proposed that not going to address those issues anytime soon. So I'm quite skeptical about kind of medium and longer term outlook. Having said that, I mean, every policy supported on a day-to-day basis probably positive.
So we continue to watch China for sure. Maria, we're sitting here with a day of really mixed earnings stories. We've got one stock falling, you know, really sinking as a result of negativity around that business. I'm thinking of Maersk here. We've got a payments business in the Netherlands, Adyen, really soaring on the back of their numbers. It's an extremely difficult picture to read. What are you watching for specifically when it comes to the winners and losers in this earnings picture?
Margins. To me, it's all about margins. So if you think that margins can be protected, great. And that, I mean, as we were talking with Krishna before, is that companies that are able to generate cash, companies that protect their margins, they are really kind of do's and don'ts these days. And so margins, free cash flow, so those things really, really important right now. And that kind of, broadly speaking, leads us to this large cap quality growth type stocks that have been leading markets. So to us, it's very few kind of, the earnings season has not provided like the reason to change kind of underlying views on kind of big trends we saw last year, kind of this momentum, large cap growth, and kind of split between mega cap tech and everything else. So that stays the same. And as I'm saying, margins, free cash flows, ability to afford dividends, so those are important factors.
Maria Weitman, head of equity research over at State Street Global Markets. We thank you so much. We look forward to having you right back on the show. In the meantime, let's get a quick check on some of the individual stocks on the move. Joe Easton has that story. Joe.
We got some massive moves on the top of the board here. You were running through a couple of them a moment ago. Take a look at AP Immerse, down 11% at the moment, warning of a slowdown in the shipping business. Now, if we go back to pre-November, before the crisis in the Red Sea, they were already saying this, and analysts were warning that the industry was over capacity in terms of how much they built up during the pandemic, given the increase in demand and also supply chain issues. There was too much capacity. And now Maersk reiterating that, but the stock only giving up around half of the gains that it's seen since the Red Sea crisis in November. So bear that in mind when we look at that one, down 10%. Then we've got Adyen, a big decliner a big gainer, I should say. I can't get a read on these markets this morning. That one up 18% in Amsterdam. They are reporting that they are increasing some of their market share. That's in contrast to what we saw from PayPal yesterday in the US, slumping as they warn of declining shares in terms of the payments company. So that one, a big mover today. Soitec and Kering, both of these stocks, one in chips and then Kering, the Gucci owner, they actually had negative calls this morning from analysts, but gaining potentially the negativity in chips and also the luxury space. Both of those may be priced in this morning, and as such, we're seeing gains in those. Then we got AstraZeneca, a miss on the EPS top line. It is the cancer drugs in focus, a cancer giant now, as it's refocused on that over the past few years, but that miss is weighing on that firm in the UK. Then a couple of other UK firms. We go from oncology to Ben & Jerry's and Hellmann's Mayonnaise with Unilever. That one up 3%. Pretty much better than expected margins on that one this morning. So that one, a good mover on the FTSE 100. Anglo-American, they're focusing on the diamond business in the statement, potentially writing down some of the value of that business at the moment, seeing weakness in the De Beers business. So that is potentially negative. But again, that stock gaining, potentially the broader business not doing as bad as expected, but difficult moves to gauge this morning. Then we'll flip over and have a look at a couple of others on the screen here. We go to your morning calls. Now, Pandora reported yesterday, less than a week to go till Valentine's Day, so do get into Pandora if you can. But that one gets a new buy rating. That one over at HSBC, up almost 2% at the moment. It's the lower end of luxury, potentially still accessible, potentially will remain resilient as the luxury sales weaken, according to analysts. And London Stock Exchange downgraded at UBS. This is a valuation call from the guys at UBS. That one falling 0.6%, potentially some FX headwinds as well, according to that note. So that one is slipping in London.
Joe, thank you very much. Joe Easton from our equities team. Joe mentioned Unilever, and shares of Unilever are trading higher. We're up this morning by 3.5%. And it's interesting because this is the first of the big majors, FMCG, the fast-moving consumer goods sector, the first of them, big food companies to be reporting earnings. Of course, they don't just do food, they do plenty more besides. But could the results signal that consumers are ready to buy as inflation has been dropping? They can afford more again.
Yeah, this is, I mean, the tricky part for a lot of these consumer brands, right? Do you do price hikes in the margins of volume dropping, or do you decrease your prices, keep the consumer, have kind of lower price good, but then make sure your volume growth is there? And that seems to be the strategy that Unilever's taking.
Shrinkflation. How much shrinkflation have we seen?
We saw a lot of that, didn't we?
We've seen a lot of that. And that's how they've managed.
Chocolate bars were my favourite.
I'm sure they are, but they've got smaller.
Does that just apply, though, to food, or do you see that in things like deodorant, for example? Is that like then a smaller product? And how quickly does that take then to kind of adjust in terms of manufacturing?
I need to defer to greater minds than mine. I'm sure somebody here in this building is doing some analysis on shrinkflation as we speak. But price inflation, has that encouraged shoppers to buy more? That is one of the key themes here. The volume story, the mix story, as Kriti was talking about, always crucial when it comes to a business like Unilever. Let's listen in to Bloomberg's Francine Lacroix speaking to the CEO of Unilever.
Consumer companies have reported over the last couple of years quite significant growth numbers and top-line numbers. Now the question is, how can we start to grow volumes again and not just rely on price? And, you see consumers in different parts of the world responding differently to that. But overall, I would say there is easing inflation, and it's a matter of dialing up the volume knob. And I'm very happy that in the fourth quarter, we reported a 1.8% volume growth across the portfolio, with an even stronger picture for our top 30 brands. That is an important element of the plan to, focus our spend and our resources behind the biggest bets, behind the biggest brands, representing roughly 75% of our total portfolio.
And is it still more difficult actually to get the margin up to when it comes to food compared to, for example, personal care? Yeah,
I think if you look at food, again, over the last years, we have not passed on our costs fully into pricing to the consumer. We didn't think that was responsible. So our margins have suffered in food. We see margins now coming back, and in the last 6 months of 2023, our overall margins, gross margins, improved by 330 basis points. That is an important part of that growth action plan, to improve our gross margins, because that's the bank in consumer product companies, for where you can decide on to invest behind your brands, behind your people, in R&D. So I see early positive signs, but there is more to do.
As far as I can remember, actually, there's always been pressure on Unilever to break up. Do you feel that pressure, or to prove that you don't need to break up?
Well, in this job, you should feel a healthy pressure. But I would say the biggest opportunity for value creation is to simply improve what we have. Over the last years, our profit has been relatively flat. Whether there was currency or whether there were other reasons, our top line was somewhat behind our competition. And I'm seeing sequential improvement over the last 6 months. I'm excited about that because I feel that there is momentum and that we can unlock the potential of the company. And unlocking the potential of the company is first and foremost on everything that we own.
Ice cream was a bit disappointing. What will you do with it? What will you do with the ice cream division?
Well, ice cream has had a difficult year. Many reasons. What we've done is we've appointed a new leader, and since then we've acted very, very fast. So appointed new leader, roughly 80% of that leadership across the business group has been changed. We're looking for strong productivity improvements. We're looking for transformation in some of our supply chain areas to improve the overall system. And we're making bigger bets on some of our core brands. We should say, ice cream is probably the most premiumized portfolio that we have. So, going back to your earlier question, if you think about inflation, that has hit ice cream over the last couple of years. It's a discretionary category, and consumers have dialed down a little bit in that sense. But hey, that's not an excuse. Going forward, we should improve, and we've taken measures, and we're executing against them.
There's one company that's a bit of a star of the show at the moment in Europe, and that's Novo Nordisk with Ozempic. Does that make your life difficult?
No, I mean, I saw, of course, the stellar performance of that company, and lots of talk about it. But if you look at our nutrition and portfolio, we are primarily about taste elevation, with sauces and condiments and cooking aids such as Knorr, which is our second biggest brand. And these are relatively small quantities. They're not so much in that field. So I think our portfolio is quite resilient from a foods perspective. Hey, we're watching it obviously very, very closely.
I mean, I think the chief executive of Novo Nordisk told us that actually he had a number of food chief executives call him to ask for advice.
I didn't call him.
You did not call.
No. Well, as I say, you can never close your eyes on any development that's happening. I think it's very intriguing, but at this point, we're cruising forward. We're not seeing an impact in our business from that, and I believe our portfolio is a bit more resilient to those developments.
How do you address greenwashing?
Well, look, I mean, a couple of months ago, it was before Christmas, here in the UK, local authorities have started an investigation. They've announced that as well on, are your products living up to the claims that you make? And we believe we do. Look, that announcement came in, was surprising to us, but we're currently working with the authorities through that investigation, giving all the information and data that they need, and it's not something that I would like to see.
I mean, Unilever in the past has always, sold with purpose or sold with a point of view. Mm-hmm. If you look at the conflict between, Hamas and Israel, it's difficult to understand the position because of Ben and Jerry's and kind of different entities. How do you deal with that?
Well, look, as a company, the conflicts that you're alluding to, by the way, are very complex conflicts. As a company, we operate in many geographies around the world, so we're not taking a stance in very complex matters. You won't see me doing that. You won't see the company doing that. And Ben & Jerry's is a very particular case. Ben & Jerry's has an independent social mission board, and sometimes they give their views. And hey, that was part of an acquisition agreement that was made long before my time.
Hi, Schumacher, the Unilever CEO, talking to Francine a little bit earlier on this morning. That stock having a very solid start to the day. Elsewhere, much more mixed, particularly in the CAC 40. The CAC 40 is the French market this morning, providing me with a few surprises. Kering doing really well this morning, up by 1.72%. Apparently, the Gucci numbers were tolerable. I don't know quite what that means, but apparently the market's okay with them. They weren't great, but they were apparently tolerable.
What did Anna say early? Gucci's doing
good. Gucci equals good. Not so good, but apparently tolerably.
Gucci is Gucci. That's the way you
tolerably
say it.
Good this morning. Now she wants to talk about Gucci.
I do.
So Gucci's doing. Gucci could be worse. Basically, seems to be the narrative. Soc Gen's actually fairly flat. I saw the numbers first thing this morning and thought they'd get maybe dinged a little bit more, but maybe expectations were low. But the real surprise this morning is Crédit Agricole, which is soft, very soft, 4.4% off the pace this morning.
Yeah, and the street wrap telling me this morning on the Bloomberg terminal that shares are falling because people are looking through the net profit number and focused on the underlying pre-tax income, which missed consensus estimates. Sounds like one for Caroline.
It does. Caroline Conan joins us now from Paris. Walk us through the numbers. So BNP kind of set us up. Plug in Soc Gen, plug in Agricole this morning for me. In particular, what's going on with Agricole? Anna's just given us the street wrap version of why the stock is lower this morning. What are you hearing?
It does seem that some analysts are disappointed with the underlying performance at Crédit Agricole because even though it was a beat on net income, it was actually a miss on revenues, and some analysts seem to also be wondering what it means for costs at Crédit Agricole going forward. Of course, in this fourth quarter, they have benefited from the interest rate situation in their Italian business. So their Italian retail is up and contributing to an increase of 9% in revenues for international retail. But also, at the same time, they are saying that the contribution from these high interest rates may have peaked, especially for the Italian business, reaching a ceiling. That's what the Deputy CEO, Jérôme Grivet, said in your interview earlier. So even though the fixed income trading revenues is down 3%, which is actually not as bad as peers and not as bad as Wall Street, there are some concerns on the underlying performance of this French bank.
Yeah, Caroline, let's just have a listen to what we heard from Jérôme Grivet. On the cost side, interesting, you talked about the cost being an area of focus. He was certainly saying people shouldn't worry about that because of acquisitions they've done. But then this is on, let's listen to what he had to say about the sustainability of their performance in FIC. This is Jérôme Grivet from Crédit Agricole.
Well, we've posted indeed very high results for our fixed income business, but it's a long trend of improvement for us. Just as an illustration of that, last year, CACIB was the #2 in bond issuances in euro worldwide. It was #3 1 year before, and it was #5 back in 2021. So it's a permanent improvement, and we think it's very sustainable.
So that's the more positive story that Crédit Agricole is telling around FIC performance and the sustainability of outperformance there. What's the broader outlook for French banks then, Caroline, after we've heard from so many of them?
In fact, interestingly, on the outlook, we should look at Société Générale because, you know, Slawomir Krupa, the new CEO, has been in charge for the past 3 quarters. And in fact, he disappointed with his strategic plan announced last September in London, where he said that revenues would only increase between 0 and 2% per year. And this morning, actually, Société Générale is increasing their outlook for revenues, and they're saying it could actually increase by 5% this year, so a much better performance. Still, investors, of course, are still working out what is the transition period with the new CEO, Slawomir Krupa, who took over from Moody's last year. And if you look at the fixed income trading, they were actually down 22% in the 4th quarter. It's not as bad as BNP Paribas, which was down 32%, but it is not as good as Wall Street. So, of course, trading will be something that investors will have to watch going forward. But this new outlook for Société Générale could perhaps give a little bit of optimism about this transition period of Slawomir Krupa.
Caroline Conan in Paris, we thank you so much for breaking all of that down for us. Guy, Anna, to me, it is still the story of that trading revenue that she was talking about. I don't understand why these French banks are having such a tough time with bond trading when there's so much bond volatility, when there's so much rate cut commentary at the moment, the insatiable demand for bonds. This should be a no-brainer, and it's not.
But some of them are outperforming Wall Street.
Yeah.
I guess it's a mixed bag. It depended if you were on the right side of those trades.
Yeah, and this is the primary market as well that we're talking about. And there's huge demand, certainly in the primary market. A lot of companies are still looking to refinance. That's certainly been a big theme. They're worried about kind of what the outlook looks like, trying to get maybe that nailed down. First couple of weeks of this year, in fact, January, absolutely sensational in terms of the primary market. Maersk is down really hard. It's now down by 12, 13%, which is fascinating. Astra's off as well. I'm interested that the market is not focusing more on the margin outlook when it comes to Astra, but certainly the kind of the headline numbers are enough maybe to knock the stock first.
Maria was telling us, a guest from State Street at the top of the hour, all about margin, wasn't she, Chrissy?
I mean, that matters across the sector. We're talking about banks. It matters for the consumer sector as well. Kering was one of the outperformers on the French index now, pairing all of those gains, only higher by 0.2%. Coming up, we explore that more when it comes to Gucci sales falling more than expected. That stock, like I said, giving up those early gains. We're going to figure out why next. Stick with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
This is Markets Today. We're about 30 minutes into the European trading day. It's my favorite phrase, sum of all parts trade, because you are seeing some big movers to the downside, to the upside. Your biggest weight on the stock 600 is Maersk, almost 13% decline, taking the index down by about 20%. 20% of the stock 600 move is just the Maersk drop. So that's pretty big. But then you've got some good news as well, trickled in through here, or spread throughout here. Unilever, for example, outperforming this morning.
Unilever feels like an obvious one to me. Some of the others are more surprising.
Yeah.
It's interesting where the market is focusing this morning. Agricole's a good example, I think. Caring's a good example. Maybe that kind of the initial kind of read-through that we would have all had turns out to be the wrong one. Agricole down pretty hard. Caring's really volatile, though.
Yeah, absolutely. I mean, it just on the other big movers of the morning, it speaks to the market cap of AstraZeneca that even though you've got something like Maersk down so substantially, down by nearly 13%, it is AstraZeneca that's down 2%, taking the most points off the stock 600, which is quite incredible. Adyen on the other side, that one up by 14%, and that business delivering a very strong story that's all about the consumer. So once again, you kind of scratch your head about where the consumer is heading right now. Maybe that ties in with the Unilever story, that as inflation has been coming down, people have felt slightly more in control and able to spend.
Can we talk about British American Tobacco for a second?
Go for
because
it.
they are outperforming 5% off of earnings. This is not a company that I look at particularly often, but a 5% move off earnings is pretty substantial.
Yeah, in an increasingly tough regulatory environment as well. So that's something certainly to keep in mind. Should we get back to the luxury stories? Because
definitely Gucci
we need
is what
some
we need to
analysis
talk
of
about.
that one. Yeah, Guy's desperate to jump into the Gucci story. Go on, Guy. Tell us
I'm
your
surprised. So you've got a new designer, Sabato De Sarno, who has come in. How much time do you give a new designer? So Gucci's had some really kind of incredible designers in the past. You think about kind of Tom Ford when Gucci ultimately got taken over by Kering. So you go back all the way. So designers make a massive difference. Critty's laughing at me.
I'm sorry, your knowledge of this is just so much deeper
I remember
than
covering.
mine.
So I remember covering when this all happened.
Yeah.
When Gucci kind of resisted and didn't want to be taken over, and then ultimately got taken over.
Yeah.
I'm trying to think of the guy that was running the business at the time. It was Tom Ford and somebody else.
Who played you in that movie, by the way, the one with Lady Gaga? Did you have a character in there?
I'm really surprised that I didn't. But, anyway, it was a long time ago. But designers make a big difference, and you can see this at Burberry as well, which is really struggling to get traction with its new designer too.
Yeah.
And where these designers go can make a huge difference. The last designer, Michele, did have a really big impact on Gucci. Does De Sarno have the same sort of impact, and where does he take the business?
Let's get another view on this, shall we? Let's get to our European luxury correspondent in Paris, very well placed. Angelina Rascouret joins us now with her thoughts on this. What did you take away from this earnings story? Because when we saw the initial lines crossing, the red headline crossing, Angelina, a little earlier on this morning, that looked like something that would send a stock down. Recurring operating income declining versus 2023. What did you take away from the report?
Yes, indeed. That was a negative headline. I mean, we were expecting the sales at Gucci, the biggest label, to drop. They fell by 4%, which was slightly worse than expected. But indeed, they warned that profitability in 2024 is going to drop versus last year. As they invest in their biggest labels. The stock initially reacted positively. I think now it's about flat, and at some point it turned negative. But basically, I think the investors were sort of expecting it could be actually worse. So it's a wait and see. Let's see how the trading session goes.
Angelina, how long do they give the designer, Sabato De Sarno, the new designer that's coming in, how long does the market give him to kind of gain traction with this brand once again? The mood music seems to be that he wants to take it kind of up the exclusivity scale. Is that what we're going to see?
Yes, exactly. That's the strategy at Kering. He was named about a year ago. His first collection was unveiled in September in Milan. And actually, the products from that collection will only start to be in stores this month. So there's always a lag there. So investors have to be patient. And he reiterated today in the presentation to analyst François-Henri Pinault, the CEO of Kering, he reiterated Gucci is on an elevation strategy. The turnaround will not happen overnight. And part of that elevation strategy is try to emulate what some of his peers do. For instance, he mentioned that, they plan to curb the availability of certain products. It's all about scarcity. Luxury, it's all about desirability. So I think he's going to be following, the playbook of some successful players there.
Angelina, talk to us about some of the other brands under Kering here. We're getting comments from the CFO that's pointing to a challenging year at Alexander McQueen. Tai saying Balenciaga went to a tough year as well. Outside of Gucci, where does the growth come from?
Exactly. I mean, the growth, it's got some very, powerful brands, well-known brands. The second biggest brand is Yves Saint Laurent, which has been on elevation strategy. I mean, that's the name of the game for all the brands inside Kering. First of all, you want to control your distribution. So what they've been doing over the past few years is to rationalize the wholesale distribution. Basically, you only want to sell your products in your store because that means you can control pricing, you can control your image, and you're going to be doing what they say is, they call clienteling, basically engaging in a personal relationship between the salespeople and the customer. So that's very important. And then you've got another, very exclusive brand that's called Bottega Veneta and Balenciaga. Balenciaga has been in a tricky situation over the past 2 years because they had a big scandal at the end of 2022, and now they're recovering. So, but basically, I mean, all of these brands are facing as well a slowdown compared to the post-pandemic boom years. So demand is sort of normalizing there. So that's also the context.
Yeah. Clienteling. I didn't know there was a word for that, Angelina. I thought they just were coming to chat to me because, they fancy some conversation. But no, I was being played. Let me ask you about the rest of the sector then. You talk about how the story at Kering is going to be one of withholding some of the stock, and that sounds like Hermès. Tell us how the rest of the sector's doing.
I mean, the rest of the sector, we've seen it's a mixed bag. Burberry, we know that they're suffering. Again, they're an independent brand. Q4, the last quarter of last year was difficult for them. Richemont and LVMH are showing that they're resilient. They have some big mega brands. Richemont, you think about Cartier. At LVMH, you think about Louis Vuitton and Christian Dior. And they show they're resilient. There's still appetite for their brands. And tomorrow we're getting results from Hermès, and Hermès is generally considered to be the top of the top. When you talk about scarcity, desirability, Hermès, they're the experts at that. Basically, demand for their bags exceeds their output capacity.
Absolutely. What a great business model. Angelina, thank you very much indeed. Angelina Raspe joining us out of Paris on the luxury sector. Hermès tomorrow.
Yeah.
Looking forward to that one as we've just been hearing. That they've nailed it in terms of getting the mix right, that exclusivity right. But also then you're in the right demo, aren't you? The upper end is where spending continues to be really, really strong. It continues maybe because of what's happening in the stock market. The stock market continues to absolutely surge. It's interesting that Bitcoin, I don't know if you can draw a correlation between Bitcoin and what's happening in the luxury sector.
Okay, go ahead.
But Bitcoin continues to be really strong.
That's what a lot of people said, yeah.
Actually, precisely. The line between Bitcoin and watches is very, very strong. Is it something, the consumer still feels like they're in great shape. The upper end consumer still feels like they're in great shape. The equity market is still in great shape.
Yeah.
All of that kind of fits together.
To me, it's the strategy that I'm learning all about. I'm putting my American hat on here. When you look at these luxury houses in Europe, it is about premiumization. We saw that in Diageo as well. You saw it in the spirits business. But then when you look at kind of the American version of this, I'm thinking Michael Kors.
What's the American version?
Well, I'm thinking about Michael Kors, for example. Tapestry, they took over Kate Spade. They took over Stuart Weitzman, Jimmy Choo as well. You have them attempting to kind of create what Kering and LVMH represent, but are doing it in a way that appeals to this kind of mass consumption model. It's where in certain parts of, Dallas, Texas, for example, where I am, everyone owns a Michael Kors bag.
Isn't that where the consumer is going to be hit the hardest, though? The upper end is where spending is likely to be more resilient. In the middle, that's where the squeeze comes.
But I think it depends, because if you look at still the consumers of say, Michael Kors bags, for example, they are still upper end of the American consumption bracket.
I find it interesting. We had a conversation about luxury spend, and China didn't really feature as part of that. And that was just the whole story some years ago, wasn't it? So
but now it's Middle Eastern, no?
Yeah, that too. But the fact that it hasn't been all about China, and China has been so weak, and yet that isn't showing
Chinese
up in
tourists in particular.
Yeah, exactly.
It used to be the case. You'd turn up in Paris, you go to the Champs-Elysees, you'd stand outside whatever kind of luxury shop it was, there'd be a queue around the block. That's not there anymore.
I'm sorry, I was just going to say, is the takeaway then that the European consumer matters again in terms of the
US consumer, perhaps,
and holding up better than anticipated.
Right. And now China does play in one of the other stories we've been dealing with this morning, so we should get to that coming up on the program. Siemens shares have been slipping after a sharp drop in China factory automation orders. So that's another angle on the China slowdown. We'll break down those numbers next. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
I'm very supportive of being patient, to get to where we need to get. I see at this point the trade-off, which is, coming into better balance, is still being in favor of continuing to work on inflation.
At some point, the continued cooling of inflation and labor markets may make it appropriate to reduce the target range for the federal funds rate. On the other hand, if progress on disinflation for some reason stalls, it may be appropriate to hold the target range steady at its current level for longer to ensure continued progress on our dual mandate.
Expecting all indicators to be well aligned is too high a bar. But seeing sustained, broadening signs of progress should provide the necessary confidence that I would need to begin a methodical adjustment to our policy stance.
Federal Reserve Bank governors Thomas Barkin, Adriana Kugler, and Susan Collins all speaking there. They're notably missing Neil Kashkari, who, by the way, has had a very interesting take in the last 24 hours, talking about 2 to 3 rate cuts from the person who's supposed to be the Fed's most hawkish member. I suppose the 2 to 3 rate cuts in an environment where the market's pricing 7 is hawkish.
It's on message.
That fits with the dots, doesn't it? You got 75 bips in the dots, 2 to 3, but what he's basically signaling is the risk is that maybe they do a little bit less. Certainly with the data at the moment pointing us in that direction.
Yeah, sounds sensible. I mean, to your point, maybe that wasn't his dot. It maybe fits with the median dot. Maybe he's coming back down to median. So yeah, that's the signal that matters, I suppose.
Where's Neil Kashkari's dot? We have to investigate. No, I think it's interesting, but what I'm still waiting for Neil Kashkari's opinion on, frankly, is the supply story. And we still haven't heard him actually opine on that piece of the equation where 3-4 months ago, when we were seeing that major sell-off on the long end of the curve, he was saying, look, these are where the liquidity cracks are emerging. He hasn't spoken out about that yet.
It's true. And I think we're going to get a 30-year auction today, so it'll be interesting to see kind of what's happening at the long end of the curve.
The 10-year just... It was okay.
The 10-year got taken. But it's interesting that we've gone back to talking about the rate story as much. The QT story is still, I think, interesting, and how the Fed manages the liquidity around what is happening in the market at the moment, I think, is fascinating. But you are still seeing, it appears at the moment that the liquidity story is still manageable, but that is where a lot of people that worry about the plumbing are starting to get more and more concerned. So you do wonder, can they address that plumbing issue and the QT issue and still keep rates where they are? I think is an interesting question. The Fed's that's going to be a difficult juggling act, I think, later on this year.
Is this where we talk about commercial real estate again? I mean, we have the Credit Agricole CEO about it, and he said this is nothing.
Well, for them, he was saying that their real estate portfolio more broadly
the mortgage market.
Is very much a mortgage market. It's French people owning homes and that sort of thing. I think our team dug out 32 billion euros as the commercial real estate number, and we don't have a geographical breakdown on that, but that's the sort of section that is commercial real estate, which is much smaller than the bigger number he was giving us around the mortgage market.
I don't know where the risk is, but it is interesting. Clearly, nobody knows where the risk is, but it is interesting that the market has priced in an extra cut since this CRE story started to emerge again. And that just feels like an insurance cut from the market. The market's basically saying, we don't know, so we'll price in the greater possibility that actually there is a shock that comes from CRE and put that in. The market's just being
wishful.
It's just being a discounting mechanism. It's the logical thing to do, isn't it? You just price that extra risk in.
But it comes back to the fundamental story that Mark Cudmore was talking about on our show yesterday, which is we're kind of looking at past crises and trying to detect it again. When it comes to the mortgage market, when it comes to commercial real estate, even when it comes to China, for example, this idea that perhaps the Chinese market is going to have some sort of read-through.
Well, this is a crisis that seems to still be delivering for some European businesses. We heard from Siemens this morning. They're seeing a sharp drop in their China factory automation orders, and this is something that's really weighing on the business there. Let's get to our colleague Oliver Crook, who joins us with analysis of what we got from Siemens. Ollie, good morning. This is a stock that is down a little today, not surprisingly so perhaps, but they've seen orders largely stagnate, it would seem, in China. What stood out to you from these numbers?
Yeah, so really a mixed bag from Siemens, where you have the sort of 3 main units. The one that kind of did fairly well was mobility, so all the sort of traditional Siemens stuff you think of, train production and that sort of thing. But really the weakness came from the digital industries business, which is now their most important business, and it's sort of the invisible fabric that exists between the digital world and the sort of factory world, and it's really down to one thing. This is driven by one thing. We heard from the CEO, it's digital industries, but what region? Have a listen.
The Chinese market is still very, very slow.
It's driven by lower private consumption, weaker global economy obviously has an impact on an export country. So that machine builders, automotive, but also food and beverage and other verticals like pharma, they are still low in demand. And this is the reason for automation to be low.
So really, it's a China story. The slowdown in China showing no sort of signs of abating. I asked him, when do you see this turning around? He said, hopefully in the back half of the year. This is now becoming almost kind of a running joke of when is the China recovery? Oh, it's in the other half of the year, right? So I think that they're just looking at that as sort of hopefully, but not necessarily guaranteed. A couple other things that stood out, the outlook, they left it unchanged. But one thing where there's perhaps some overlap with Hermes is the backlog, the demand here for their business. Their backlog of orders is 113 billion euros. That is a new record for Siemens.
And how are they going to make sure that that all gets delivered if they're all moving to a 4-day week? What did he say about, and this is a new story for you, Ollie, Germany going to a 4-day week, everybody's going to chill out, we can relax, we can take it easy, 3-day weekend, absolutely fantastic. What did he have to say?
Yeah, well, listen, he may take a slightly different view of that. You may be shocked to hear. But what I asked him about was wages, right? Because I was wondering how much wage pressure is there given the labor shortage in Germany. He's saying that it's something that they're thinking about, that they need to pay attention to, and it's going to be inflationary, right? ECB is paying close attention. He talked about productivity. I said, productivity, have you thought about a 4-day week? Have a listen.
I'm convinced that we should bring people into work and encourage them to work more, not less. We're living in aging societies. Germany is an aging society. So it's better to have the people who are and who want to work and who can work to make them work even longer. My proposal was recently to, after 30, 35 hours of work, to reduce the tax in order to encourage people to work more.
So fairly unambiguous there. More work, not less work. Perhaps not welcome news for the Siemens employees watching this morning.
Ollie, you've been speaking to a lot of European corporates, Siemens just one of them. Talk to us about how they're thinking about a potential Trump presidency. We're getting closer and closer to Super Tuesday. He seems to be the front runner. It's looking like it's going to be Trump versus Biden. How are they thinking about it?
Yeah, Kriti, there's no way around the fact that this is hanging very large over everybody in Europe, whether you're a corporate, whether you're a politician, a policymaker. I mean, a lot of the companies do not want to speak on the record about this. What I will say is that they are certainly thinking about it. We know now the EU has run an impact assessment, is trying to figure out what a Trump presidency means for the EU, namely on one topic, trade. I think we've got the graphic there looking at the U.S. trade. And as you look at this, right, you see a few things. Since Trump was elected in 2016, look at the trade between Europe and the United States has absolutely exploded. The other thing that you're going to pay attention to is the imbalance in trade. We're talking about 150 billion euros worth of it. That is something that Trump will obviously pay attention to, has been very vocal in the past. But even if Biden gets reelected, this is a more protectionist Biden that we saw going into the his first term. The Inflation Reduction Act, has not pleased everybody in Europe, as we know. So really, this leaves Europe in a very vulnerable position, particularly when the Chinese market, as we've just heard from Siemens, is not really picking up the way that they would like to see it. So very intensely, vulnerable, and you have to imagine there's a lot of stress tests going on in C-suites right now.
Yeah, I'm sure there are. Oliver, thank you very much. Bloomberg's Oliver Crook talking to us about the way that Europe is preparing for whatever US politics throws at it later on this year, and indeed some of the corporate earnings stories that we've had out this morning. Let's stick with that theme. Sam Onstead joins us from the Markets Today blog with a focus on some of the UK stories under the microscope this morning. Sam, good morning. Let's start with Unilever then on that front. Unilever returning to volume growth, and this has been a big question. When a time when inflation was running so high, volumes came down. Now inflation's come down, volumes are going up. This seems to be the sort of the mix in the way it falls for Unilever.
Yeah, and actually, so Unilever is the first of the really big consumer companies to report. As you say, that was the big question going into this. How much more space is there to raise prices when inflation has come down and consumers' budgets are a little bit more squeezed? And actually, Unilever does say in there that over the course of this year, that balance between pricing and volume growth is going to be much closer to each other than it has been. I think for Unilever today, the key thing was not just the return to volume growth, but it's the return to volume growth in the beauty and personal care businesses, which are higher margin than some of the other parts of the business. Ice cream, for example, did quite poorly, and actually ice cream is suffering quite a bit from this downtrading amongst consumers who are buying, a lot of own label products. We saw that a lot with the grocers. And I think that also, and we've got this mentioned in the story today quite nicely, this is something that's been brought up by investors and analysts with Unilever as to whether they need to think about splitting the business.
I hate to be trivial, but I did hear him say ice cream has been disappointing, and I thought, I never have that experience.
I heard him say that as well. Not an experience I've ever had.
No, never.
A poor ice cream. What do they make? They make what? Magnums
Magnum.
and yeah,
Ben and Jerry's,
Ben and
of
Jerry's.
course, and they talked about some of that politics there. Where else should we go? I know that you've been covering the housing market, Sam. And there's some better signs there. We talked about this a little yesterday, didn't we? About how the rates curve has been pulling more people into the housing market.
So it has been, but I got the 3-year swap in front of me, 3-year swap rate. It's picking back up again. So it's come down very sharply, but swaps are now starting. So I wonder whether this kind of the mortgage drop that we've seen is maybe starting to abate, and whether that the kind of the momentum we're seeing now is very retrospective, and whether or not it starts to ease off a little bit.
Yeah, I think what you tend to see now with the housing market, so you get these house price reports. So we had Halifax out yesterday. House prices up again a little bit, but only by a little bit. And I think still the forecast for the year, maybe they rise a little bit. Mostly it's kind of this stagnation. The reports we had out today from Rightmove and from Rix show that both buyers and sellers are coming back into the market. But actually, that's kind of the issue that caused this stagnation at the end of last year, where all the transactions started to go down, is that there's a big mismatch between the expectations. So buyers, have got less money to play with because mortgage rates have gone up, and sellers are seeing house prices rise a little bit and are getting a little bit more confident about the asking prices.
That seller's number from Rightmove was quite stunning, wasn't it? They said the number of people getting in touch with an agent to sell surged 23% to a record from a year ago in January. There's a lot of pent-up sales.
It's a really low base,
aren't there? And there's a lot of pent-up sales then as a result, because that the high interest rate story discouraged so many people from moving at all.
Yeah, I think that's true, and so competition in the mortgage market is creating a little bit of better sentiment. But I do think that the issue that will continue to be over the course of this year is this mismatch between what buyers want and what sellers want, and unless that comes closer together, the transaction volumes don't pick up. Yesterday we had this merger between Barratt and Redrow. And if you look at their results, in the second half of last year, Barratt's completions went down by a third, their profit fell by about 80%. Transactions really dipped at the end of last year, and a lot of that is because of this mismatch between expectations of price for buyers and sellers.
So does that make rental prices are going to be coming down now? Is it time to move?
It's cheaper I think in the UK it's just become cheaper again to buy.
Yes, because of that surge in rental prices, which is such a story. Sam, thanks so much for joining us. Sam Munster from our Markets Today blog. You can find that blog, of course. Go to the front page of the Bloomberg UK website, or type TLIVGO on the Bloomberg terminal. Chrissy, what do we have coming up today?
Yeah, let's go through the daybook here. 9 a.m. London time, the ECB releasing the economic bulletin. 1:30 p.m. London time. U.S. initial jobless claims are coming out, and that's at 6 p.m. London time. Excuse me, I'm going to redo this. 6 p.m. London time, the U.S. 30-year Treasury bonds auction is happening. We're going to be watching a lot on supply there. And, of course, the $25 billion, the U.S. Treasury Secretary Janet Yellen will be speaking at the Senate Banking Committee hearing as well.
Okay, and so those are the sort of set-piece events, the data that's breaking. We've got a number of corporate stories that are really going to be in focus for us. Plenty more conversations coming up. The CFO of Walt Disney will be talking to the team. We started the program talking about that. And the CEO of ARM also joining the team, as well as the Richmond Fed president. So we've got the macro covered. But on those micro conversations, Disney, plenty of news flow generated there. ARM, a really strong story, a really strong mover after hours, wasn't it?
Absolutely sensational. And they're moving, they're becoming an AI story, which I think is kind of the narrative that they've been looking for. Good for SoftBank.
Very good for SoftBank. It's a server chip story. If not ARM, then who? I think is more of the question for me. I feel like they could throw their hat into anything, and it would be well received.
Pretty's less on the Gucci today, more on the server chips.
Yes, we're learning a lot here.
Okay, enjoy the rest of the day, folks. From Pretty Anna and me, thank you very much indeed for watching. We'll do it all again tomorrow. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. It's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Adyen shares rocket as the Dutch payments firm beat estimates with increased volumes due to higher consumer spending. Now, we speak to the company's co-chief executive later this hour. Unilever actually beat estimates as easing price inflation encouraged shoppers to buy more products. We'll have more from our interview with the company's chief executive on his turnaround plan. Plus, our exclusive conversation with Carlo Messina. He's the chief executive of Intesa Sanpaolo on rising profit and a new share buyback at Italy's largest bank. So we have a lot of interviews to get through, a lot of the focus, of course, on earnings. But first thing is first, let's take a look at the European markets map. Now, when you look at earnings, it is a bit of a tale of two cities. If you do well, the share price goes up. There's nothing to write home about that. But Unilever is certainly on the upside. And then Crédit Agricole actually a little bit lower in today's trading session. The other thing that people are really watching out for, it does seem investors are looking past some of the concerns that the Fed officials have said on when exactly they'll start cutting rates. They've also managed to look through some of the concerns in commercial real estate, but they're looking at this Treasury auction. This is a 30-year. Now, a 10-year, a 5-year went okay. The 30-year, so longer maturity, could be a little bit more difficult to get through. European markets, you can see the CAC 40 gaining some 0.1%, so a little bit tentative, a bit of a tepid with, of course, these sector moves depending on earnings that came out. Now, to talk about the markets, we're joined by Tatiana Puhan, a Chief Investment Officer at Copernicus Wealth Management. Tatiana, thank you for joining us. When you look at Treasury auctions, when you look at what we've heard from the Fed, and when you look at earnings, what do you think will support the market going forward?
Well, I think it's above all, what central banks are going to do. So very clearly, the current scenario that is still priced in is one where investors really bet on, a high likelihood that, the Fed will start cutting rates in March. Which I think is actually not that likely. So we can get some, changes in sentiment due to that. And then also, the earnings picture in the US, it has come in relatively stable, but in Europe, clearly, we get very weak signals. So let's see, what's still going to happen in the next 1 or 2 weeks. But that is also going to determine to quite some extent, where sentiment is going to move.
So, Tatiana, what are you expecting from the Fed? Again, we've had a number of Fed officials saying that they're just in a bit of a wait-and-see situation. Is this really because the jobs number is, if not incomprehensible, difficult to understand what the repercussions are 2 to 3 months from now?
Yeah, I think it's extremely difficult to understand. And I think, I can also not tell you what is going to happen going forward, as central bankers cannot do, I think, at the moment, because we get signals, that go in one and the other direction. So you can interpret them as, the labor market being still quite robust, and, generally speaking, a supportive kind of environment in the US economy, but you could also interpret it in terms of, maybe things are slowing down. So it's not very clear, but I don't think that central bankers will act on unclear signals. So I think they need more reassurance coming from data, to actually act and to start cutting rates. And so far, the signals are not clear enough so that, I would see them actually acting on that.
Tatiana, one of the other things that actually a lot of investors actually talk about without really actioning is their worry about debt, especially debt in the U.S. and the fact that it could hit at some point a Treasury auction. Is today the day? I know there is a bit of concern about a 30-year auction because, of course, it behaves differently to a 5-year or 10-year. Could we see something, if not today, in the next couple of months?
Yeah, I think, in that respect, also the outcome of the US elections will be actually very, very interesting because, if we get Trump, then for sure, we will not see austerity. So, what is going to happen then? And, what are bond markets going to do then about it? And might they try to sort of show Trump that it's better, that he actually keeps a little bit of budgetary discipline? And so, I think further out this year, also when elections come closer, I think that will have a larger impact on bond markets and bond market volatility.
So what does that mean on where you want to be invested in? So as Chief Investment Officer, what are your top 3 calls right now?
So what we're trying to do is we're trying to play some sort of barbell game. So on the one hand side, we still try to be very much exposed to these kind of long-term growth trends, which we see, for instance, in tech or in tech-related names. So that is one thing that we very clearly still play. But on the other hand, we also try to position ourselves, for the risk that we cannot predict, which is like, the risk of some major political accident happening. And for this, we try to be positioned in assets that, would help us in such a situation, which are maybe related to commodity energies, but also defense sector. And then we also play some themes which are a bit more kind of orthogonal, let's say, such as, long-term energy transition and themes like this.
So, Tatiana, valuations in Europe are certainly much lower than elsewhere in the world. Is that justified, and how do you play Europe?
Well, Europe for us is, of course, a region, where we do have exposure because we have a lot of European clients, but it's something where we have actually a clear underweight since quite some time now, because we believe that, Europe has actually not done its homework for a lot of years, has structural problems, and has a much less dynamic economy. And so while we are selective in, the names that we allocate to in Europe, we kind of prefer to underweight that region because we think that also like the euro exposure is actually not necessarily very favorable to have in a portfolio. And so that's why we stick to a very selected range of names, and we try to overweight US names. We try to overweight also alternative themes that are actually not dependent on pure market beta.
Tatiana, when you look at Switzerland, it is a safe haven. How long can it be a safe haven for? I know there's quite a lot of calls on actually Swiss franc and some of the things that the central bank could put in place.
Yeah, of course. I mean, like Switzerland, I think to some extent we should not underestimate that we are within Europe, and Europe is such an important trade partner for us. And so obviously, if Europe has a big problem, then Switzerland can also not be completely disconnected from that. That is clearly true. Also, the Swiss franc has probably been very much supported, by SNB, by the SNB over the last 12 months or so. So, it remains to be seen now what happens next to the Swiss franc. We think that still the Swiss economy is very robust. We didn't have really an issue about inflation because actually prices have already been quite high. And we also think that, especially the large companies in Switzerland, they have a very diversified and very robust business model. So still, it's probably a safe haven, but we shouldn't believe that we can be completely disconnected, from what happens around us.
Thank you so much, Tatiana Puhan, there, Chief Investment Officer at Copernicus Wealth Management. Now, a couple of earnings that we're actually keeping an eye on. ARM, for example, soaring after the chip designer gave a surprisingly bullish forecast, showing that its push beyond smartphones is helping fuel growth and profitability. You can see ARM Holdings 23% higher. Now, coming up, we'll be speaking exclusively to the chief executive of Italy's largest bank as higher interest rates continued to fuel earnings. Our interview with Carlo Messina of Intesa Sanpaolo next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Well, the conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, two French banks reported results earlier. Crédit Agricole shares taking a hit today as investors look past the bank's net profit beat. Rival Société Générale has vowed to increase revenue by at least 5% this year, and this comes as the chief executive simplifies the lender. Now, SocGen is to return about 1 billion euros to shareholders this year. Now, from French banks to Italy's largest, Intesa Sanpaolo is announcing a new share buyback worth almost 1.7 billion euros. That's after fourth quarter results that showed net income rising 49% from a year earlier. Well, I'm very pleased to be joined for an exclusive conversation with the Chief Executive Officer of Intesa Sanpaolo, Carlo Messina. Mr. Messina, thank you so much, as always, for joining us here on The Pulse. Could you give us a sense of first of all, how content you are with the results and how much more you can do and how much more you can give back to shareholders?
We are very happy of the results. Obviously, results are sustainable. So what we consider important is that this is a trend that will continue in 2024 and 2025. Another point in which we are very satisfied is that these results include also 300 million of support for inequality and poverty in our country. So not considering this, the total net income will have exceeded 8 billion euro, but it is part of a story of being also an impact bank for Intesa Sanpaolo, and also the ability to continue to give significant remuneration to our shareholders that will continue also in the next years.
Carlo, last year you raised the bank's guidance 3 times, of course, as higher rates are lifting income from lending. What will happen in the next 12 months if rates go down?
So rates going down for Intesa Sanpaolo will be a lever of extra profit in comparison to 2023, because we will benefit of two elements. The first one is the hedging on deposit side, so it's a replicating portfolio that will give us a significant net income. Just to give you an idea, in case of interest rates will remain on average the same level that we are today on average, so 3.3, 3.4, we will have an extra contribution from hedging for an amount of 800, 900 million euros net interest income. At the same time, with the reduction of Euribor, we will have an acceleration in wealth management and protection. You know that we have 1.3 trillion euros of wealth of Italian families, and the acceleration in fee and commissions will accelerate the growth of revenues in 2024.
You have said, of course, in the past, as always, that the bank's cleanup is a priority. What kind of deleveraging trend can we expect from Intesa Sanpaolo?
So, you know, Francine, today we have less than 5 billion euros net non-performing loans. So we are a Nordic bank in terms of risk profile. And you remember that in the past, Intesa Sanpaolo, like all the Italian bank, was considered the problem in terms of non-performing loans. Now we are the clear leader in the market in terms of net non-performing loans. So our risk profile today is equivalent to a Nordic bank, but with the acceleration that we can have from wealth management and protection. Looking at the asset quality, we have no kind of point of attention for 2024, also because we increased the coverage in area that can be problematic. We solved all the commercial real estate problematic that we can have for the future. We solved in 2023, and we still remain with 900 million euros of overlays available in case of need during 2024. So I think that we are in a unique position in the European landscape.
Can you talk to me a little bit, Carlo Messina, about commercial real estate? So something that started in the US this week, there's a bit of concern that actually it's touching or even infecting Europe. How much commercial real estate that could be worrying do you have in the bank?
So we used to have in 2023 two or three significant deals on commercial real estate that could be problematic for the company. One is called Milano Sesto, but we sold during 2023, and now we do not expect any kind of risk in this area. That could be an amount of 1 billion euros. So we are talking about significant exposure, but now it is totally under control. Then we have two other positions that we sold during 2023 with extra provisions or devaluation of the assets during 2023, and now the remaining part of portfolio is totally under control, is mainly residential, and with a lot of houses that are under a process of selling from the owner. So our expectation is that in this sector, maintaining a strong focus of attention, obviously, but we do not be in a position to have a negative surprise during 2024.
But Carlo, do you expect some kind of credit event in this space, even if you seem to be telling me that actually the credit exposure of Intesa Sanpaolo is pretty small to commercial real estate? Is that right?
Yes, absolutely. Our exposure is very limited. The portion at risk has been sold in 2023. So my expectation is that in any case, on asset quality, we will not have any kind of surprise during 2024. Our expectation in terms of cost of risk for 2024 is below 40 basis points, with a run rate of 30 basis points and 10 basis points available for disposal and further reduction of non-performing loans, because remember, we want to remain a net zero NPL bank, and so this means that we have to continue to make some form of disposal during 2024. But this is fundamental for a bank, because I think that in the phase in which we have very positive net income, it is very safe to have a kind of provisioning that is not close to zero, but remain in the range of 30, 40 basis points.
I mean, there's worry out there, of course, about geopolitics, about the strength of German economy. There's worries about politics in the U.S. and maybe some of the tariffs that a potential president could put in place. Do you worry about the prospects for Italy given all of these uncertainties?
So it is clear that from a geopolitical point of view, we have to consider some point of attention. Especially my point of attention is the relative weaknesses in terms of geopolitical of Europe. So at the end, we should need a Europe in which there should be a Ministry of Economy of Europe, a Ministry of Defense of Europe, a banking union. So all these points are under-evaluated in terms of geopolitical strength of Europe. So USA and China and all the other players can have an acceleration in their ability to be key player. Europe still remain something like a bureaucratic number of countries trying to do their own interests, but not the European interest. This could be something that can reduce the strength of Europe in comparison with the other key players. And at the end, it results in a potential lower acceleration of GDP in Europe in comparison with other counterparties. But looking at the trend also in any kind of negative situation, we will have growth in Europe and also in Italy.
Carlo, can you update us on what's going on with the Russian unit? So, you had said that this was put up for sale. I think there's local media reports saying that there are ongoing discussions about selling this to local management. Is that correct?
We are trying to solve. This is the remaining exposure that we have towards Russia. So we have today very limited exposure. It's something negligible in terms of exposure. It is a matter of geopolitical exposure that we remain to have that is very limited in comparison with a significant number of peers. And for the other significant number of peers, Russia seems not to be an issue. So, but in any case, I will continue to make a disclosure on Russia. Russia is the subsidiary that we have in Russia is a portion that we are trying to make a disposal of this counterparty. There is an involvement of the local management in this transaction and also of other counterparties, obviously all according not in sanctioned situations, so in something that is according to law. But it is not easy to complete a disposal, also because also in Russia you have some bureaucratic steps that you need to have in this kind of transaction. So for the time being, we still maintain our exposure. In our approach, in difference with other players, is to make the complete devaluation of net income coming from this subsidiary. So in contribution from consolidated level in Intesa Sanpaolo is zero. In other banks is significant.
Carlo Messina, thank you, as always, for your time. The chief executive there of Intesa Sanpaolo, actually having a very good week. I think the share price has gained some 8%. Coming up, the Danish shipping company Immerse sinking below deck. In today's trading session, we explain why. This is Bloomberg.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Maersk shares plunging after saying it expects a slowdown to global shipping. That's even when a current boost to freight rates from the Red Sea conflict evaporates. Now, Chief Executive Vincent Clerc spoke to Bloomberg earlier.
We've not seen the level of threat actually peak. To the contrary, if you look at how the attacks have developed in the last few days, the zone that is under danger is bigger than it was. The amount or the range of weapons that are being used for these attacks is expanding. And there is no clear line of sight to when and how the international community will be able to mobilize itself and guarantee safe passage for us.
Well, that was Vincent Clerc, the Maersk chief executive. Also, ARM soars after the chip designer gave a surprisingly bullish forecast showing that its push beyond smartphones is helping fuel growth and profitability. Coming up, we're joined by the co-chief executive of payments giant Adyen, shares soaring after net revenue beats estimate. If you look at the share price, I think it's up some 17%. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenevec bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Shares surge in pre-market after a bullish growth forecast from the chip designer helping the S&P close in on 5,000 for the first time. Well, Adyen shares actually rocket as the Dutch payments firm beat estimates with increased volumes due to higher consumer spending. We speak to the company's co-chief executive in just a moment. And Unilever beat estimates as easing price inflation encouraged shoppers to buy more products. We'll have more from our interview with the company's chief executive on his turnaround plan. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Dutch payments giant Adyen is the biggest gainer on the stock 600 after second half net revenue came in as a beat. Now that's as increased consumer spending boosted the company's volumes. The results offer some relief after surprisingly weak first half earnings. So let's speak to the Adyen co-chief executive Ingo Uytdehaage. Thank you so much, Mr. Uytdehaage, for joining us. I mean, if you look at the share price, it's gaining some 16%. It's a good set of results. What actually made North America your fastest growing market in the second half?
Yeah, exactly. I think it's the outcome of years of building our business in North America. I think the positive thing that we see in our business is that it's basically across all the commercial pillars that we have defined. So we have traction in unified commerce, we have traction on the digital side, but also in our platforms offering. And that leads to a success in North America, where we saw 27% growth in the second half of the year.
Is this a number of customers that you've actually increased? And is it big customers, or were you able to actually increase prices?
No, it's mostly focusing on our land and expand strategy with our existing customers. So we typically work with our largest customers and get more volume over time. I think what we see in the US happening is that more and more customers trust us with their volumes. For instance, if you look at digital, we gained a lot of volume on the digital side, where we worked with our customers to give us more share of wallet, and that makes these results.
So what does that mean for, the trend forward? This was a good set of numbers after a difficult first half. Are you confident that you'll actually be able to build on this and that it's not going to be a stop-start strategy?
Yeah, no, exactly. I think we've always been building for the long term. That has been the strategy of the company since the start. We had indeed a slower half year in 2023. And that's also why we explained during the Investor Day in November how we look to the next 3 years. For 24, we expect to grow in between the 20s and the 30s, and we guided on the low end of the range for 24. So that's how we want to continue to build our business and basically build on the second half of this year.
I mean, outside of the US, do you see any big customer wins in other parts of the world?
Yeah, so if you look, for instance, at Europe, we expanded our partnership with Klarna, which is an important customer of us. But we also continue to work with new customers like S Group from the Nordics, who is everyday retail, and that have selected us because of our unified commerce offering, how we basically can integrate online and in-store payments. I think these are examples how we also grow outside of the US in a very significant way.
So when you look at how much digital spending there has been, you're also a great barometer to try and figure out exactly what's going on with consumers around the world. Are you surprised that there has been an increase in spending in the US, given inflationary pressures and given the interest rate environment?
Yeah, like for us, it's always hard to exactly distinguish between our share of wallet gains and how consumer spending looks like. I think if you typically see now at our volumes, we certainly have increased our market share in the US. But of course, for instance, on the unified commerce side, you see that there is a bit of pressure on retail growth. And I think that's also visible in the speed of growth in the US on the unified commerce side. And that's, of course, something that we want to turn around going forward. But we are dependent on the macro there.
So have you seen any kind of patterns of how people are spending changing? Or is it just because of that you're increasing market share?
Yeah, I think in our situation, it is mostly the result of increasing our share of wallet with our existing customers. It's always been our strategy, and that's also what is reflected in our results. If you look at our growth numbers, these are certainly not the numbers how the market is growing. We're growing significantly faster than the market. So that's why we see these results right now.
I know in the past you've said, like, look, you don't really want to join the price fight with some of your competitors. Will that change given the environment you're operating in and also given the increased market share?
Yeah, I think the way how we've always approached this is that we want to work with our customers to bring the best value. So total cost of ownership is an important element how we discuss payments with our customers. And we strongly believe that we can help drive down total cost of ownership. That does not necessarily mean that we are the cheapest in the industry, if you just look at the face value of our pricing, but it means that if you work with us, you get to better results. And that's ultimately where our customers are looking for. And that's also why we are convinced that we continue to gain market share in this indeed very competitive market. But customers are willing to pay for value. And I think that's what we're bringing in this market.
I know there was a little bit of shockwaves across the industry when PayPal, of course, announced that it was reducing the workforce by a significant amount of number. I think it's 9% of the workforce. Is that going to be a concern for the industry, worldwide? Is it something that you need to consider as well?
Yeah, if you look at our strategy, we have invested in a team over the past 2 years, which was quite counter-cyclical. I think we also got a bit of pushback from some people on it. But we feel that we're ready for this next phase of Adyen. So we have the skills and the skill now to help our customers on a global basis. And also for this year, so for 24, we expect to grow the team with a couple of hundred people. So we will certainly continue to invest in our team, mostly on the engineering and commercial side, and also mostly outside of Amsterdam, where we were originally started the company.
Yeah. Ingo, when you look at your, pretty sizable big customers, is there an industry that you want to target this year? Do you have something in mind? Is there an industry that you think you'll be able to pick up customers easier?
Well, I think the beauty of our business, and I think where we are right now, is that we see many verticals where we have traction. So whether that's on the digital side, also what you see reflected now in the numbers, where we have a lot of traction with a couple of fintech players, where we see a lot of traction on the unified commerce side, S Group as an example that we just discussed. But also on the platform side, a lot of our software as service providers, they see embedded payments as a core of their proposition. That's the starting point. And then on top of that, we work with them on innovations, including what we can do with our embedded financial products portfolio, what we can do with issuing, what we can do with capital or bank accounts. And this is really where having an integrated offering, including our banking licenses in different markets, is going to help us to grow. So I think my summary will be like we are very well positioned in multiple industries and in multiple markets. And I think that's also why we strongly believe that we can keep the growth that you have seen.
Ingo, thank you so much for joining us today. That was the Adyen Co-Chief Executive, Ingo Uytterhage. Now, coming up, I speak to the fashion entrepreneur, Emma Greed, about diversity, inclusion, and her really journey to success. That's next, and this is Bloomberg.
Do you think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
This is Bloomberg.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, the Kardashians have built a multi-billion-dollar fashion empire, but central to their success is a British businesswoman. Emma Grede is the chief executive and co-founder of inclusive fashion brand Good American. She's also a founding partner of shapewear label Skims. Now, the entrepreneur spoke with me about her rise to the top, how she measures success, and why diversity remains elusive in the world of fashion.
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women, we're going to let women make their choices, and hopefully we're going to take some of that pain out of what it means to be left out of the conversation or not represented in fashion. And we've done that pretty well, I think.
So, Emma, you have this idea, right, of inclusivity, of making women feel good.
Mm-hmm.
Who do you talk about it with first?
Funnily enough, my husband. You know, because I think that we're both entrepreneurs, and so it's natural for me to bat any idea backwards and forwards with him. But, you know, I've worked for years in the fashion business, and so I've been part of the problem, right? It's like I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
And I think this is a pattern with a lot of entrepreneurs or successful companies. Is there a danger that, you know, some entrepreneurs look at numbers too much and look for, you know, a gap in the market where
It's very true. It's very true. And I think that's one way to approach things. And there's a certain sense, but for me, you know, I go with my gut, and gut instinct tells me a lot, and I tend not to go against my gut. Now, I'd be lying if I said I didn't run some numbers and feel like there was commercial opportunity here, right? Nobody makes 19 sizes of anything without thinking, I reckon I can sell them somewhere along the line. But I definitely think so much more of what I've done throughout my career has been in response to a feeling that I've had and then acting on that feeling.
Were you surprised at how many other people felt like you?
Yeah.
Were you?
Yeah, honestly, I mean, it's one of those things that, like, on paper, Good American has been such a massive success. But if you wind back to day one, everyone's like, you sold $1 million in day one. The truth is, 9 o'clock I was the hero. By 11 o'clock, I had no stock left. And everyone was like, you have no idea what you're doing, do you? And I was like, no, actually, I don't. And in a way, that was my first lesson in what it means to be excellent from a customer experience point of view, because I just started emailing people. And I was like, how long do I think people will wait? Turns out not that long, certainly not as long as it was going to take me to make stock. I was emailing customers. Well, both, actually. I was like, can you help me get some more fabric? Will you wait 8 weeks for a pair of jeans? And somewhere in that, it all kind of worked out. But I think, again, what people respond to is brands that have authenticity, and there's a level of honesty that's needed. And I went and said, you know what? We had no idea how popular and how much this was going to chime with customers. And if you can just be patient, we're going to get you something. Hands up, we know we messed up and we don't want to disappoint you. And there's a part of that honesty that actually really chimed with people. They knew that we weren't feeding them the line. It was clearly not written by a PR, because I couldn't afford PR at that point.
Were you signing Emma?
Oh yeah, like lots of love, Emma X. How I'd speak to my mom or something.
Has fashion done? It hasn't done enough when it comes to inclusivity and diversity, but has it done something in the last 5 to 10 years?
Well, it's interesting because fashion, as quick as it is to change, like in the kind of aesthetic, it's very difficult to change a system, right? And I think that comes down to who makes decisions. And the people that make decisions in fashion don't typically look like me. They aren't typically women all the time. When we look at who's at the helm of the biggest high street players, it tends to be the same type of people. And so I honestly think there's a lot of work to be done. Progress has definitely happened, but you only have to look at the last New York Fashion Week, which is the biggest and the most commercial, to see that there's so much tokenism around what inclusivity really means. And I think that especially when it comes to size, we're back where we were 20 or 30 years ago when you'd have one single black model that would walk down the catwalk. Now we're in that same situation where, I can't remember the stat, but I think it's less than 3% of models that came down the catwalk were above a size 12. A size 12 is less than average. And so there's just so much work to be done there. And it almost size is the last allowed taboo. We're allowed to disclude people because of their size, and it's really crazy.
But do you worry the impact this has on society, because it's through social media? So actually what was in the realm of fashion maybe 10 years ago is now pervasive with, our girls, our sisters. And so I was reading something saying, people feel a bit rubbish when they look at all this stuff because they don't feel represented and they feel that there's something wrong with them.
Yeah, and that's the whole reason I started the brand, because, if you go back 7 years ago, I was pregnant with my second child, a girl, and I really felt that deeply, how much time and effort you can spend and waste time. And to me, it's if you take out some of that, worry and the strife around how much we think about our looks and instead put our energy into saying, I need a pay rise, I think I should be doing something else with my life. Part of it was really what happens if you shift and change the paradigm of how people see themselves? And, it's a really trite sentence, but representation really matters. When you see a version of yourself in something, there's a level of acceptance. And that's what I wanted to do, just level the playing field and say, you know what, we all look different, we all are different, and that's okay. That is not what we should be thinking about. We should be thinking about, equal pay. They're the things that we should use our time for as women. Let's just get an equality going with men. And that throughout the workplace, throughout all of the industries. And honestly, I feel the media has such a huge impact on us. And I don't mean just fashion media, I mean the media at large. And so we need to see better representation everywhere in society.
Is that why you're doing Dragon's Den?
As I've got more successful, I thought a lot about what it means to be an entrepreneur, because they talk about it being really small at the top. top, but it's not small at the top. Like, it's minuscule. It's the same people doing the same deals, giving each other money, who all typically went to like one of 5 or 6 schools. And so for me, you know, because I'm on Shark Tank in the US, and the idea of Dragon's Den, and that you could be an entrepreneur with seemingly very little background and absolutely no access to funding, and walk on and get a check to start to do something that means something to you and that can mean something for your family. I'm like, why wouldn't you? You know, it wasn't so long ago that I was out fundraising. And so I'm just like, if I could be a small part of somebody's journey that wouldn't usually get the opportunity, to me, it just makes so much sense. And it's not just about women, not just about women of color. It's like, if you didn't have the means or the education to know anything differently than getting up and going to work every day, that doesn't mean to say you can't have a successful business.
And you can watch the full interview with Emma Green on Leaders with Laqua later this month, and she's also actually on Dragon's Den this evening. Coming up, we hear what the Chief Executive Officer of Unilever has to say after the company returns to volume growth. We talk deodorants, magnums, mayonnaise, ice cream. That's next, and this is Bloomberg.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Laqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Actually preparing for everything. Our industry is a fantastic industry, but it's also a challenging industry. We face challenges all the time, and fundamentally, at the end of the day, for us, the focus is innovating. The more challenges we face, the more, in the end, we have to focus on innovation and do it faster and better, and that's to the benefit of patients, ultimately.
Well, that was the AstraZeneca Chief Executive Pascal Soriot after the UK drug maker reported lower than expected profit and a forecast for this year that failed to allay concerns about margins. Now, they're also clinching deals to enter new fields like weight loss. And the maker of the iconic Magnum ice cream, Unilever, reported 4.7% sales growth in final quarter of 2023 as easing price inflation encouraged shoppers to buy more. But challenges remain, of course, for their flagship ice cream business, just as weight loss drugs are changing the appetites of consumers. Now, we spoke to the Chief Executive Officer, Heinz Schumacher, a little bit earlier.
Yeah, a difficult year. Many reasons. What we've done is we've appointed a new leader, and since then we've acted very, very fast. So appointed a new leader, roughly 80% of that leadership across the business group has been changed. We're looking for strong productivity improvements. We're looking for transformation in some of our supply chain areas to improve the overall system. And we're making bigger bets on some of our core brands. You know, we should say, I mean, ice cream is probably the most premiumized portfolio that we have. So, you know, going back to your earlier question, if you think about inflation, that has hit ice cream over the last couple of years. It's a discretionary category, and consumers have dialed down a little bit in that sense. But hey, that's not an excuse. Going forward, we should improve, and we've taken measures, and we're executing against them.
There's one company that's a bit of a star of the show at the moment in Europe, and that's Novo Nordisk with Ozempic. Does that make your life difficult?
No, I mean, I saw, of course, the stellar performance of that company, and lots of talk about it. But if you look at our nutrition and portfolio, we are primarily about taste elevation, you know, with sauces and condiments and cooking aids such as Knorr, which is our second biggest brand. And you know, these are relatively small, quantities. They're not so much in that field. So I think our portfolio is quite resilient from a foods perspective. Hey, we're watching it obviously very, very closely.
I mean, I think the chief executive of Novo Nordisk told us that actually he had a number of food chief executives call him to ask for advice.
I didn't call him.
You did not call?
No. Well, as I say, you know, you can never close your eyes on any development that's happening. I think it's very intriguing, but at this point, we're cruising forward. We're not seeing an impact in our business from that, and I believe our portfolio is a bit more resilient to those developments.
Well, that was the Chief Executive Officer of Unilever, Heinz Schumacher, speaking to me earlier as the consumer company returns to volume growth. Now, a couple of other stocks actually were watching ARM soaring after the chip designer gave a surprisingly bullish forecast, showing that its push beyond smartphones is helping fuel growth and profitability. Then Walt Disney reported adjusted first quarter earnings that beat expectations and gave a full year profit forecast $1 billion of repurchases in 2024. Stocks and bonds posted small moves today. Investors again grappling with a slew of company reports and prepared for a sale of a 30-year U.S. government debt. Now, there is a lot of speculation, of course, of what this means. We did have a successful 5-year auction, a 10-year auction, a 30-year could be a little bit more tricky. So this is really seen as a bond sale test. Again, I guess because it's a 30 years, so the longer maturity debt could prove a little bit of a tougher test for investor appetite. It's very clear that on the week, markets have largely shrugged off fears around commercial real estate sector and also seem to have absorbed so far a run of warnings from Fed policymakers that a cut is not likely until May at the earliest. We're talking about the Fed. Up next, it's Bloomberg Brief. Danny Berger and Manus Cranny, both from New York. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Good morning from our world headquarters in New York. I'm Manus Crenny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The S&P is on the cusp of hitting 5,000 for the first time ever. That's while China's stocks rally, loses momentum as the markets enter the Lunar New Year holiday.
Maersk warns of a shipping slowdown later this year and says the Red Sea threat hasn't peaked.
Plus, ARM soars, bullish growth forecasts, and Disney's also on the move higher, cutting costs, and the theme parks, they deliver gains. I want one of these hats with 5,000 on it.
I know. I think we should make them. We can Bloomberg Brief brand them.
On top of looking for an apartment, she's got to get caps made. Let's talk about the bond auction, because it was a silent auction yesterday in many ways. There was no tear down. There was no rip down. They turned up. Those bond traders were stoic. It was a solid bid to cover ratio, 5.56. That is more than the previous 6 auctions. So what you are looking at here is a strong takedown. Today, it's a 30-year paper. Will the appetite be as robust? That's the question that we need to ask ourselves. There was no break of ranks in the Fed speak yesterday. Kashkari, he mooted that it would take a few months to deliver on the rate cuts. Bottom of your screen is 2-year government notes, 441. Let's see how the bond market stacks up today. So we've got 25 billion of 30-year paper. Dollar yen, this is dollar up, yen lower, because if you think that they're going to go fast and furious with rate hikes, as PIMCO say in Japan, not so quick. Uchida, the deputy governor, says rate increases won't be continuous, and nor will they be rapid. And therefore, you have this move lower in yen, higher in dollar. You can thank Danny Berger for the dollar-yen note. Brent is up by 1/8 of 1% this morning. We'll take the bid from anywhere. We're up by 2.4% on Brent. Yes, you have Red Sea issues, but we are on the longest winning streak since September of last year. So it's a number of pivot points in the energy market. Good morning. Get me a cap, Danny.
Manus, I don't have enough time. I'm now realizing I don't have enough time to put together, Bloomberg Brief 5,000 caps for us. but maybe the rest of the world will, because we are so close to 5,000. The futures market is already there. It is trending lower this morning, ever so slightly, not even 1/10%, but it's at 5,000. Now we wait for the cash market to wake up and potentially catch up. So what did we get? We got an S&P 500 future, S&P cash session all-time high, a Dow all-time high, NASDAQ hits a 2-year high. Meanwhile, Mag 7 also hits an all-time high. So we're just taking a brief pause, a breather from all of that. NASDAQ is higher, maybe helped by the outperformance of ARM. It's on the bottom of your screen, up 22%, a bullish forecast thanks to the fact that they're moving out from just beyond smartphones. Manis, there are 3 things that are certain in life. It is death, taxes, and my beloved small caps underperforming. Russell 2000 futures are lower this morning, down by about 0.4%. They had a bad day yesterday too, even despite the fact that NYCB gave that update saying they're selling off assets. That didn't help small caps. We are still lower this morning. But when it comes to the other earnings, Manis, perhaps this is part of the reason that we keep hitting all-time highs, is that the outlook for companies is brighter. If you go to TA on your terminal, it's the text analysis. It shows you just how much different phrases are being mentioned on corporate calls. This one that I'm specifically tracking here is the phrase weak demand. It was one of the top trending phrases in the last quarter. Look at this now, Manis. We've gone down significantly. In other words, just from the language of CEOs, they're not so worried about demand.
You've just taught me a new function. 14 years into the gig, and you taught me a new function. There you go. You learn something new. But look, it's a question of who's going to capitulate on their calls, isn't it, Danny, on this recession? You brought it to our attention the other day. Deutsche Bank was one of the first institutions to call for a pretty brutal recession. They thought rates would go to 5–6%. They thought that unemployment would rise significantly, and you're going to be several percentages of job losses. None of that has come to pass, but then this is the conundrum of the new economics in a post-pandemic world, in a revolution in the job market.
Yes, the demand is still there. The job market is still strong, even though credit card delinquencies potentially trending higher.
But they're not in excess of where they were in 2019, and that's what we said yesterday. So this is capitulation, or just a reassessment. I mean, it's a bit brutal to say capitulation, but it is a mea culpa. We know the traders at JP Morgan are capable of that.
No, it's a tone shift, and part of the reason why the S&P is going to new highs.
Okay, but let's talk about it. I want to cap. You've got other things to do today. You told me already that you haven't got the time for that kind of, folly. But we are chasing the 5,000 dream on the S&P 500, yet another record high. But there is a warning from BlackRock's Jean Bovin. He writes, we agree inflation will near 2% this year. We see the powering the equity rally for some time, yet we stay nimble and we are ready to pivot. The rally could falter later this year. Heresy, Jean Bovin, heresy. Now, look, what is it that makes you nervous and could take us away from these halcyon days of 5,000?
Yeah, well, let me just start by being clear here that we think this rally, has legs, and we think that has room to run, and we're overweight U.S. equities at this juncture. So we think this soft landing narrative that has become consensus is pretty powerful. It's going to take time for it to be challenged, but we do think that the inflation story is not resolved. We're going to see 2%. We're going to hit 2%, and I think that's going to feed these hopes and the rally and the bullishness for the months to come. I think the Fed will be cutting rates. That's the big story, right? It's not so much about March, but it's about they're cutting. So that's going to be pretty powerful. But when we get to later this year, we think inflation starts to go back up towards 3%. And when that becomes clear, this is where I think we're going to see some challenges for risk assets.
So inflation goes back up towards 3%. It's what you and many others have talked about, this inflation roller coaster. Corporates might have to be dealing with the same genre. I just want to quickly play you what the CEO of Unilever told us earlier this morning on margins. Take a listen.
We have not passed on our costs fully into pricing to the consumer. We didn't think that was responsible. So our margins have suffered in food. We see margins now coming back, and in the last 6 months of 2023, our overall margins, gross margins, improved by 330 basis points.
Jean, I just think that's interesting, him saying we haven't passed on the full amount of cost increases that we can to the consumer. Are you expecting that to also be another addition to the possible resurgence of inflation, pricing power coming back for these corporations?
Yeah, so I think, when we think about inflation coming back, an alternative is that we don't see the inflation coming back, but it's being eaten into lower margins by companies. So it could play both ways. Either way, though, I don't think this is good news for equities down the road. But this is another kind of roller coaster because, and that's important, in the near term, earnings are being held up. We're seeing that coming through with the season. I think we see companies being able to lower costs, maybe hit some of the cost pressure into their margin, but they have room to maneuver right now. So I think this is still constructive. That doesn't derail the rally. It's really more the roller coaster story that comes later this year, and I think we're going to see it in inflation and or earnings and margins.
How's that going to impact the bond market? I mean, we're dealing with record bond issuance yesterday in the 10 years. We'll see the 30-year paper today. It was a very stoic bond market. It absorbed the delivery in size. You talk about the resurgence risk in inflation, but how do I look at bonds in the interim period? I've got a lot of people coming on saying, pick up duration, it's fair value here at 4.25. You want to pick up credit, it should be well behaved given the scenario that you outline. Is that fine for now, but then be ready to pivot?
I think this is going to also be ready to pivot. So this environment now, we're going to see central banks starting to cut rates. The inflation we think we're going to see will not be apparent for some time. I think this is going to be like constructive for bond, and I think like there's going to be a temptation to go longer in duration and across the curve. So we have conviction on the short-term bonds as being an interesting place to invest. You can extend that to the 5-7 year. I think that's also interesting for now. But the farther you go down, then I think the more risky it becomes, 10 years plus. We're neutral right now, but I think on a strategic horizon, if you think 1 year and beyond, we are more concerned and underweight because we think yields will be higher than 4.10 a year from now.
And as you point out, break-evens are still around 2%. They haven't really woken up to the risk that you're pointing out. And on that, we have a very united Fed. We had a whole host of speakers yesterday. The message remains the same. Inflation needs to keep printing around 2%, and then they can cut later this year. They're all talking about a cutting bias, even if it's in the back half of the year. Is that a mistake? Are they not leaving themselves enough room should there be that resurgence?
I think it's going to be, the way that they have positioned themselves since December, and I think, the December FOMC was a shocker, where we've seen basically the Fed embracing, being all in on the soft landing, immaculate disinflation scenario. So I think they've set themselves up for, a cutting bias, as you say. I think it's already, restricting their ability to be, responding to any resurgence of inflation. So I do think we're going to see, as a result, potential for a harder pivot later this year. But I think before that, they're going to cut. They're going to cut in Q2, maybe twice, 3 times. Then we have an election. I think they're going to be on the sidelines for the election. And then once the election is over, we're going to see maybe now a different picture on inflation. And that's why I don't think the expectation of 6-8 cuts this year and more next year are necessarily realistic.
Yeah, they are fairly bullish in the marketplace. Let's just give a quick pivot, excuse the pun, we've used it a bit today, to Japan, because I'm looking at 30, 34-year highs in Japanese equities, TOPIX, Nikkei, all roaring away. Yen's lower this morning. They're not going to be aggressive. When they come to tightening, it's ironic, isn't it? Uchida says the rate increases won't be continuous nor rapid. Is there going to be an additional velocity to Japanese equities, or is it fully juiced?
So so I said for U.S. equities, we think this has longer to run, but we're ready to pivot. When it comes to Japan, this is more of a an outright bullish call we have. We think this is a very constructive environment. We think there's the macro picture, the inflation picture is actually positive there. This has been a story of 2023. We think that hasn't fully played out. Actually, Japanese equities have been lagging Europe and U.S., so I think that has further to run. And the BOJ, I think, is in a great position. In fact, I think they are in a position where they can start to tweak. They don't appear to be panicked about inflationary pressure, which I think is the right thing. They've been able to start moving in that direction last year without creating, market reactions and turmoil. And so that increases our confidence that, we can go in a situation in 2024 where they start to tweak, adjust. And they've made clear, I think, overnight that this is going to be a muted response and slow and not continuous and so on. So it adds to our kind of general positiveness on Japan at this stage.
Right. Well, trading the Nikkei, trading at the highest since 1990. So good on you, Jean, if you got on that bandwagon early. Jean Boivin, thank you so much for joining us. That's Jean Boivin from BlackRock. All right, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Bloomberg has learned that Citadel was among the hedge funds that received Morgan Stanley's trade leaks for favored clients. Other recipients are said to include people at Cass Capital, Sanganti Capital, and Evolution Capital. Prosecutors have not accused any alleged buy-side participants of wrongdoing. Morgan Stanley paid $249 million to settle the investigation.
McKinsey has warned about 3,000 of its consultants that their performance was unsatisfactory and will need to improve. Sources say the firm gave employees so-called concern ratings as part of their performance reviews in recent months. Now, with the rating, employees are typically given about 3 months to show improvement in their performance. It is just the latest signal that the consulting industry is pulling back after their hiring spree during the pandemic boom.
Legal documents seen by Bloomberg News suggest Jeff Staley had indirect contact with Jeffrey Epstein for years after Staley was named head of Barclays. Staley has said he cut ties with Epstein once he became Barclays CEO. Representatives for Staley and his former employer, JP Morgan, didn't respond to requests for comments. Spokespeople for Barclays and the UK regulator FCA all declined to comment. Manus.
Well, SocGen vows to increase revenue by at least 5% this year. That's as the impact of wrong-way interest rate hedges starts to fade. The French lender is to return €1 billion to shareholders, equal to about 40% of this year's profits. That's at the lower end of the range for the lender and the promises they made. Danny?
We really got to get Krupa back on this show, don't we?
I don't think they let him back on this show. After the day he came on here and he said bonuses, massive bonuses. It was brilliant.
We'll try again.
It was actually one of the funniest interviews that we've ever done together.
It will. We're going to have to post that online again. I think we need to give
it a rerun.
We will. Okay, we got to talk about earnings coming up, Manus. Maersk, a big fall. They had warned about the slowdown in the shipping industry. CEO says the risks from the Red Sea, they're not over.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
We've not seen the level of threat actually peak. To the contrary, if you look at how the attacks have developed in the last few days, the zone that is under danger is bigger than it was. The amount or the range of weapons that are being used for these attacks is expanding, and there is no clear line of sight to when and how the international community will be able to mobilize itself and guarantee safe passage for us.
That was the CEO of Maersk speaking about the attacks on the Red Sea. Joining us now for more on the shipping company is Stefan Kovachev of Bloomberg Intelligence. Stefan, you only need to look at the share price, which as soon as it opened, drops like a rock 13%. I want to ask why we had this reaction, because already in November, Maersk did issue warnings saying it would cut 10,000 jobs. It was seeking savings. The market remained weak until 2026. What's changed to elicit this?
No, I think this time around, markets were surprised by the worse than expected outlook for 2024. So Maersk is guiding for negative EBIT, which as an analyst you don't really want to see, meaning your revenues might not be enough to cover your operating expenses. They're also guiding for free cash flow to be negative of up to $5 billion, which is not insignificant. And I think the main culprit for this is the oversupply in the industry. So what has happened in the good years for the industry back during the pandemic is that container shipping companies went out and ordered new, bigger, more cost-efficient container ships. And it takes 2 to 3 years to actually build a new container ship. So a lot of this extra capacity is coming online now, which puts downward pressure on prices and profitability, as per what Maersk discussed this morning. But it's not only negative. I think there are a few positive, brighter spots in the release, such as liquidity, something I look at a lot as a credit analyst. So they still do have a very solid liquidity of over $24 billion, which should buy them sometimes for what is, a very uncertain 2024 ahead.
And that certainly will carry them through. They talk about this oversupply for this year will materialize fully in 2024. We listened to the CEO there talking about the attacks in the Red Sea. He talks about the weaponry that's used, but he says there is no clear line of sight of how the international community will be able to mobilize itself to guarantee safe passage. I mean, this is the core angst at the moment, isn't it? The diversions and the scale of diversions.
Yeah, absolutely. And at first glance, the situation in the Red Sea is a big negative for the industry, because all of a sudden you can no longer use the shortcut via the Suez Canal to go from Asia to Europe. You have to go around Africa, which increases your costs by about 30% and your journey by about 10 days. So it sounds like a negative, but what has happened as well is that freight rates have risen by about 200 to 300%. So in a nutshell, as ships were diverted around Africa, the actual available capacity or the number of ships available went down in the industry. So, the likes of Nike and IKEA were competing for fewer ships, if you wish, which led to price rises, which is beneficial, which is good for the industry. Now, today, Maersk told us, look, this might be positive. The situation in the Red Sea is a short-term positive for sure. But in the longer term, I think supply chains will adapt. And also, the oversupply is the main driver for profitability this year, as per Maersk, which remains a negative overall.
Stefan, thank you very much, Stefan. Kovachev, Bloomberg Intelligence, focused on the liquidity within Maersk. We'll talk more about luxury goods in just a moment. Danny has been officially shopping. She has? Maybe. We'll talk to you. It's a beautiful night in New York. Morning in New York.
So the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it is then the market forces and the business incentives of global companies that transform that EU rule.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Brief. I'm Manus Cranny with Danny Berger in New York. Now, if you're struggling with weight and you're struggling with food, what do? Do you get a Ozempic, and what does that mean? We've got the CEO of Novo actually telling us that a couple of CEOs out there are calling him, asking him, how does this work? How does the GLP-1s work? How much time is it going to take? Because they are frightened about the impact of Ozempic, not just Ozempic, on the demand structure for the business. It depends who you are, really, doesn't it?
It does, but we've seen this time and time again over the past year, all these food companies. Someone like Chipotle says, we're fine. We have fresh foods. People are going to want that.
You can take me to Chipotle.
I love Chipotle. I can afford you a Chipotle. That's about it, though, Manus. I actually, though, look, all these food companies are complaining, but they're all going to have to adapt. If we're in a world where everybody isn't as hungry, doesn't want junk food, maybe that's not such a bad thing if they need to start putting out healthier food. I think that's a good thing.
I'm not all down on the sort of the food side. I mean, if you think about it, the threat is really to what Walmart and Chipotle and to others. Yes. But then you look at the other side. Back in the 90s, there was a craze for the Dukan diet, okay? Actually, the Dukan diet. It was a French diet. It was in West London. You couldn't pick up a pot of yogurt, a 0% Danone yogurt for biscuits. You could not get it. And it was to do with fat. But if you look at organizations or companies like Danone, they're going to do really well out of this because people's eating habits change. You look for higher protein, lower fat food. So it's not all bad news for everybody.
Right. Well, if you're eating less, presumably you still need all the vitamins. So all these vitamin companies can say, hey, you're not hungry, but here's a pill, here's a multivitamin, you can do whatever you want.
You can do whatever you want. Well, she does whatever she wants. She shops like Billy, but not enough to save Carrie. And of course, Gucci sales were down. This is a big pressure point in luxury. If you're not at the top of the tree, it's going to be very, very tough for you.
Right. Well, Gucci has been trying to do this reorganization, this rebrand. They've hired new people. RBC, for their part, does say it's a relief. These earnings are a relief, not because they're good, Manus, but because they're not worse than feared.
Look, I mean, if you think about it, Yves Saint Laurent was down 5%, Bottega Veneta was down 5%, but they were better than estimated, but it's still down to Gucci. Gucci is the holy grail within Kering, and that's where the pressure point was.
Just as we go, we need to look at the board of 1 year of these luxury goods stocks.
How much Hermes does she have?
The only, none, Manus, none. Maybe one, I don't know. But Hermes is the only company from these big luxury goods makers that are up 23%. Manus, I think you probably contributed more than I did.
A little.
Just a little.
A little.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
I think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
The intersections of Hollywood, Silicon Valley, and beyond.
It's Bloomberg Brief. I'm Menace Grenny in New York.
And I'm Danny Berger. Here's what you need to know.
The S&P 500 is on the cusp of hitting 5,000 for the first time ever. While Chinese stocks rally, that loses momentum. Markets enter the Lunar New Year for holidays.
Maersk warns of a shipping slowdown later this year and says the Red Sea threat hasn't yet peaked.
Plus, armed soars, a bullish growth forecast with Disney also on the rise. This as cost cuts and theme parks deliver gains.
I'm surprised you didn't make a whole new world pun. I feel like that's prime.
You're just trying to get me to sing.
I am. That's all I'm trying to do.
We're not doing that. We did that 25 years ago on another broadcaster. It didn't end well.
Yeah, I guess that's why you're at Bloomberg now. But we need it. 5:30 in the morning, a little bit of joy. Let me take you to the joy of this equity market, Manus, because we are just hanging around right now. Basically, little change. S&P 500 futures, they're ever so slightly lower. But look, the futures market is already at 5,000. Will we get there for the index? We are just inches away. It's a new high for the S&P, a new high for the Dow, a new high for the Mag 7. And the tech boosts keep coming. NASDAQ futures, those are little change, but ARM going wild this morning. ARM shares up some 24%. We're going to talk about this later in the program, but an upgrade to their outlook thanks to moving beyond smartphones. And of course, small caps are lagging, down about 0.3%. Cameron Kreis from our MLive team points out that small caps have a tendency to mean revert, unlike the rest of this market, which just trends higher. But there's a lot of concern still in the small caps, Manus. Maybe if you want the margin, you want the cash, you can't buy these, so they continue to underperform.
Yeah, you just got to keep an eye on those small caps, Danny.
Always.
Look, a blistering rally in the equity market, and it was almost like a silent auction that came through last night in the 10s, yesterday afternoon in the 10s. They stepped in, they picked up. The bid to cover ratio was 2.56, so that's better than the previous 6 auctions that you had. It was a silent auction in many ways. The question is whether they can take down the 30-year auction later on this evening in the same pace and the same style. We had BlackRock with us just a few moments ago. They're worried about a resurgence in inflation. They're ready to pivot. They are happy at the shorter end or the middle end of the curve rather than the longer end of the curve. So that's going to make this longer dated paper perhaps more difficult to absorb. Dollar yen is there. That's the dollar bid, and the yen is offered. We are lower on yen because the pace and scale of tightening in Japan will be less. The Deputy Governor Uchida says the rate increases won't be continuous, and nor will they be rapid. And Brent is up by 0.6%. We put on about 2.5% in the past 3 sessions. It's the longest winning streak since September. You've got this euphoria in risk markets, in equities, a stoic bond market, and to that extent, you get this drift higher in the oil market. Danny.
And as I gotta say, it is interesting to look at that board and look at the market reaction and know what happened in China this morning. We had CPI dropped at the fastest pace since 2009. They're throwing everything at the wall, trying to rescue a flailing stock market, and you literally would not know that by looking at these global markets.
But this goes back to the relationship, and there's a wonderful word, which is the symbiotic relationship between China growth, China inflation, and the rest of the world. We are obsessed about it in Europe, less obsessed about it here in the United States of America. To what extent are we decoupling? And that's what we chatted about this morning.
Yes, exactly. Has that decoupling happened, again, outside of Europe? Let's take that question to Jennifer McOwen, the Chief Global Economist at Capital Economics, who joins us now. Jennifer, great to see you. Good morning to you. Have we had an environment now? Are we in an environment where the global macro framework, again, putting aside Europe for just a moment, but it's finally decoupled from fears about China, and in this case, deflation fears?
Yeah, I mean, I guess the thing about Chinese deflation fears is that they're very much specific to China, and they relate to the structural forces that are driving economic weakness in China. It's not something currently that we're particularly concerned about in the advanced economies. If anything, people are still talking about renewed inflation. So given those differences, I guess that helps to explain why there aren't kind of global themes coming through in the market so far. And decoupling more generally it hasn't happened. There are still very strong trade links between China and the rest of the world, but it's not the case at the moment that we're looking at the concerns of a major hard landing in China, like, say, we did back in 2015. We're just looking at a period of economic weakness. Policymakers are stepping in to try and support the economy. So that means that the kind of the financial type contagion that you might get from a hard landing concern isn't really there at the moment.
Jennifer, good morning. Good to see you. I mean, listen, we obsess, don't we, in financial markets. One moment we're obsessed about, you know, the response mechanism from the Chinese to markets. But when it comes to inflation outside of China, you say inflation battle is already won, and that fears of that last mile being the hardest are overdone. And maybe, is that represented in the PCE on the 3 and the 6 months? Why is it that you think this last mile will be a little bit less difficult than the rest of the market thinks?
Well, I think partly because, as I said, it already has been won, really. If you look at the 6-month measures or 3-month measures, we've seen some Fed governors speaking about this over the past couple of days. They're already down into line with target, not just in the US, but to some extent in the Eurozone too. So it does look like, if we look at the more recent inflation outturns and forget the base effects, the statistical effects that impact on the annual rates, we're kind of already there. And looking ahead, what the Fed said in particular is that it wants to see more good news, not necessarily better news. Right. And I think that's certainly what we're going to see. If you look at newly signed rents, for example, they point to a collapse in CPI rents in the US.
Yeah, and that was Kashkari, right, saying that we just need to see more data around 2%, and then they can cut 2 to 3 times. Jennifer, Manus and I just moments ago were speaking with Jean Bouvin of BlackRock, who said to us that there could be an inflation resurgence. He expects there to be one. He calls it an inflation roller coaster, saying wage pressures specifically and good prices are going to stop falling. And then we get that just structurally higher than 2%. What do you make of that argument?
Well, goods prices, I see that a lot of that, those easy wins from the let-up in supply shortages that caused the initial surge in inflation are behind us. But so far as core inflation is concerned, I really don't agree, and particularly on the labour market front. In the US, in particular, productivity growth has been picking up really strongly, up at 3.2% in Q4, with the ECI measure showing that earnings growth is at 3.7%. That means unit labour costs, which are what really matter from the Fed's perspective, are only growing by about 0.5%, or were at the end of last year. So that's very low increases in unit labour costs, and certainly not something that you'd consider to be inflationary.
There's a great hesitancy in the central bankers of the world, isn't there, Jennifer? They talk about confidence. They want more confidence. I'm drawn to the RBA, the hawkish hold from the RBA, and I'm drawn back to a conversation Danny and I had with Stephen Major a couple of years ago about the tête peloton. In other words, what happens in Australia and in New Zealand sets the temperance for everywhere else. How much of the gap between where the market is pricing rate cuts and where the Fed is guiding, how much more of that work needs to be done?
Well, it depends on which side you think that the work is going to be done. I think that what's going to happen is that the Fed is going to see a lot more of this much better data and much more quickly than it seems to be anticipating at the moment. It's understandable that it's striking a very cautious tone. The ECB too, we've seen some comments from Schnabel in the past couple of days, which also seem pretty hawkish. They've had a really terrible experience over the past couple of years. The last thing any central banker wants to see is core inflation rates up at 5% or more. So it's understandable that they're still striking a very cautious tone at the moment. Also, they don't want to cause too much premature loosening of financial conditions. Markets respond in advance to what the central banks suggest they're going to do in future. But what we've seen in the past is that when the data do come in the right way, the central banks turn quite quickly to rate cuts. They don't telegraph them in the way that they do rate hikes, where it's very, very important to set out your stall very much in advance and be very, very cautious and not surprise the market. When you're cutting, there's less need to do that. And I think it will be the case that just over the next few months.
Be fair, Jennifer, that's why a lot of bond traders have been positioning the way they have, because they say just that. They're not going to telegraph cuts, so we're going to go ahead and price more in than they're saying, because that's how this thing works. Jennifer Manis talked about it this morning. We had a monster bond auction, a record bond auction, 42 billion of 10-year yields yesterday. They are absorbed fine, but CBO also came out with a budget saying that the cost to service U.S. debt will hit a record high of 3.1% of GDP next year and keep climbing. Powell said it's time for politicians to work on a fiscally sustainable path. Is that even possible with an election year? And how big of a threat is that then?
Well, in the US, unlike the situation in the UK, we're not really looking at big pre-election fiscal giveaways, are we? I guess that there's limits to what Biden can do with the Republicans in the House. So that's meant that. That's meant that you couldn't have that pre-election surge in spending. I guess the worry might be that, say, if Trump's elected or if Biden gets another term, that you get some kind of more post-election surge when there's more support behind it, and then that could cause real fiscal concerns. I think the facts are that whoever wins, they're very much constrained by the fact that the US government deficit is so high, around 7.5%, and the markets aren't going to tolerate really a significant pickup, which is why we don't think that there's any real fiscal support that's going to drive the US economy even stronger over the next year or so.
Jennifer, thank you very much for being with us. That's Jennifer McKeown of Capital Economics, our guest this morning on the macro viewpoint right here on Bloomberg. Coming up, it's been a magical quarter for Disney. Profit forecasts, brand new investment that takes the company to a whole new world.
There we go.
A whole new world.
There, oh, Manis, you've done it.
Done it. I sang on Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what
my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I'm pleased to share that the board declared that our next semi-annual dividend, to be paid in July, will be 50% higher versus the last dividend paid in January. The board has also authorized the company to begin repurchasing shares for the first time since fiscal 2018, and we plan to start by targeting $3 billion this fiscal year.
That was the Disney CEO, Bob Iger, speaking at the company's earnings call. Disney reported better than expected earnings, and they issued an upbeat profit outlook for this year. Joining us now is Geetha Raghunathan of Bloomberg Intelligence. Geetha, thank you so much for being with us. I mean, this is proof of the Iger pudding in terms of losses being dropped and dividends being boosted, isn't it? So is this a fruition moment?
It certainly is. I mean, Disney is back with a bang. There's no doubt about it. A lot of bullishness. I mean, obviously the sentiment had kind of turned, I think, a little bit, but there was obviously still a lot of nervousness. But Iger has really delivered. And, you know, it was on every metric, every possible metric. I mean, when you look at kind of the cost cuts that they have implemented, the execution has been absolutely impeccable. And then, of course, you spoke about that profit forecast really came in well above what the street was expecting. They're guiding to 20% EPS growth, which is really pretty remarkable.
Manus, I have a question for you. Have you seen either Frozen or Zootopia?
I might be familiar with the movie Frozen.
Okay, I'm the same, but apparently...
But Utopia, no.
Zootopia, not same.
Zootopia,
I think it
no.
has to do with animals, but apparently, Manus, part of the reason international parks did so well was a Frozen attraction in Hong Kong and Zootopia in Shanghai. I think neither of which it sounds like you're eager to visit anytime soon.
I'm not a Disney theme park kind of person. I've got to be honest. I've never been to a Disney theme park.
Also, Manus Craney doesn't wait in lines, so that's a problem too.
I've waited in a lot of lines in my life.
But Geetha, I mean, looking at the performance of the theme parks and the cruises, I mean, these are things that obviously people didn't want to do during COVID. Cruises especially. So looking at this, is this just a return to normalization, especially in Asia, or is this the type of growth that's sustainable for Disney?
This actually is sustainable. So obviously they did have that big post-COVID rebound. There's no doubt about it. But what they've done, and what they've done really well, is they've spent that time that when they were shut down during COVID, they spent that time kind of going through the businesses, kind of really implementing all of these operating efficiencies. And as you spoke about, really investing, continuing to invest in their theme parks. And that's going to continue, Danny, over the next 10 years. They've pledged about $60 billion to open up all these different new attractions. And what we kind of saw over the last quarter, at least, was, you know, international parks, as you just pointed out, performing really, really strongly. They're able to implement those price hikes, and they're doing a really, really good job of it. So parks right now is really the anchor for Disney, makes up about 65% of their profit, and will continue to be a huge profit driver for them.
Where and how is ESPN doing? You talk about lower costs and streaming. I mean, we're seeing pretty dynamic shifts in this sports arena of streaming, but this is about acquisition of subscribers, and ultimately it's about bolstering the overall agenda, the overall size of the business.
So I think they came up with a really good strategy for ESPN, and this is kind of what the market was looking for, right? What is the end game with ESPN? We know that cord cutting is real, sports rights fees are going up, and so their announcement, which was the Super App, which is ESPN basically joining forces with Fox and Warner Brothers Discovery to come up with this sports Super App, if you will, a little bit later this year. I think that's going to be a really good testing ground.
Do you think that could be IPO'd? I mean, if you look at that coalition of the willing, the Fox, the ESPN, and the Warner Brothers, is that a magic IPO in the making?
It could very well be. I mean, it's more than half. I think it would be close to about 60% of all the sports content on U.S. television. So definitely lots of potential there for all three companies, especially for Disney, which controls majority of the sports rights. And then remember, Manus, they are also having the ESPN standalone app, which is coming next year, which is going to be a little bit different because they are really making that a more interactive program, interactive kind of offering with a lot of sports betting, a lot of stats and things like that. So they're really doing all that they can to kind of bolster the value of ESPN, I think, going forward. And I think investors will be pretty happy with that.
I mean, can you just imagine the investment bankers licking their lips at the prospect of a IPO for ESPN?
I mean, it would be a monster. It would be a monster one. Did you see that I said the magic IPO?
Did you say magic IPO?
I said magic IPO. She doesn't listen.
I'm sorry. I should have listened. That's a good pun. I love a good pun. Geetha, thank you so much for joining us. That's Geetha Ranganathan of Bloomberg Intelligence. Another company that is going on a magic carpet ride today, man. It's soaring into the sky.
Soaring into the sky. Take it away.
Look at this thing, 24%, a bullish forecast. It pushes beyond smartphones, really helping it here. Let's get to Bloomberg's Subra Patnaik. So Subra, 24%, really strong results. Renee Haas, the CEO, is this success that, hey, we can move beyond just smartphone chips?
Morning. Yeah, it's another crazy day at the stock market for ARM. It was up 25%, on track for its record high if it goes on like that when trading starts at 9:30 a.m. in New York. Yeah, it just goes on to show that if you are providing anything now related to AI and it's bringing in money, shareholders are going to kind of rally on with you. So yeah, they're on for the ride.
Look, I mean, that's the euphoria. You tag AI into any chip story or any software story, and suddenly it's like the monetization process accelerates away, and probably rightly so. But if you were to look at the rest of the report, is there anything in there that perhaps detracts from the euphoria?
Analysts are actually a little concerned about demand coming solely from China. A huge part of the demand actually came from recovery in China. That is a little concerning, but shareholders don't seem to mind that at all today. So we'll have to see if this ends up being a problem later for ARM.
Okay, thank you so much. Yeah, the stock is up, as you can see, over the past year, up 51%. Thank you so much for being with us. That is Subrat Patnaik. Coming up on the show, we'll take a look at some of the market-moving events of the day. Undoubtedly, it is the bond auction on the 30 years, which will be laser-focused on right here on Bloomberg.
Let's
go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
It's Bloomberg Brief with Danny Berger and Manus Cranny in New York. Let's get you set up for your Thursday trading day with a look at what's ahead. Initial jobless claims, those will be out at 8:30 a.m. Eastern. Then we're going to get wholesale inventories. Those hit at 10 a.m. Plus, we're going to hear twice from Richmond Fed President Tom Barkin. First on Bloomberg TV at 8:30 a.m. and then again at 12 p.m. And then $25 billion of 30-year treasuries are going to go on sale as the last test of the week. We already had successful sales of 3- and 10-year bonds, but man, is potentially part of the reason a rally couldn't rip is because we had the 30-year today and then CPI revisions on Friday.
Yeah, it depends on what your view is. There's going to be a pop again in inflation like we heard for Jean Bouvin at BlackRock. That is their key concern. You're going to get a pop in inflation that perhaps makes the really extended long end less appealing for you. Some stocks to keep an eye on. I know we've done a couple of these already, but let's just pop in PayPal because it drops 2024 earnings per share forecast, missing the estimates, and it sets a very conservative guidance. We've already talked about Disney. It's about the theme parks in Hong Kong. It's about the theme parks in Asia doing better. It's also about that sort of the coalition of the willing on streaming and sports. We now know there's an end trajectory with ESPN. They're going to have their own app next year. Cutting costs. Bob Iger brings it home at Disney. He was brought in to really put it back into check, and he has done that. ARM is just flying higher, expanding into new markets, buoying the forecast, and that is all around the magic letters, which is AI, and about who's buying those chips, those higher processing chips. Danny?
Yeah, I mean, if you can succeed there, you're going to succeed with shareholders. Man, it's the other mover that we're keeping an eye on is the yen this morning. You got to kind of feel bad for PIMCO. PIMCO comes out with
Don't feel bad for anybody at PIMCO.
Yeah, fair enough. Okay, PIMCO comes out with a note yesterday, basically saying they think the BOJ is going to move as soon as March and then start moving aggressively. And then you cheetah today. Throwing cold water on all of that.
Yeah, I mean, the view is Deputy Governor is Uchida.
Yeah.
Said basically, look, when we move, it's not going to be that aggressive. PIMCO says it's going to be a two-step. It's going to be probably a 1-2 step. So to 0 and then to 1/4%. But that's been the pain trade all year, trying to be long yen.
Yes.
I want to be long yen. Every time everybody tries to get long yen, it's sort of your heart is ripped out of it, isn't it?
They don't call it the Widowmaker for nothing, Manus. There's a reason it has that moniker.
But you've been to Japan this year, haven't you?
I went last year? Yeah, last year. It was so cheap. It was very, very cheap.
Did you buy the snow apartment?
No, I haven't. We're going to have to go halvesies on it. Well, actually, no, maybe you buy most of it. I can't afford the Niseko apartment.
We're both in the market for an apartment later in the year when rates come down. That's us.
I need one now, Manus. I need somewhere to live.
Not in my place. That's it for Bloomberg Brief.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
What Chairman Powell told us was that a strong labor market, strong economy wouldn't preclude them from cutting rates, and I think that's still the case.
As you see from the policy speak, there is no hurry for cuts anytime soon.
That's why the Fed's pushed back. I think they have scar tissue from this inflation of the last couple of years.
Chair Powell might be having a challenge corralling everybody on the committee. I think he wants to make that first move based on a strong consensus.
The problem that we have in the market in this zombie-like economic environment where it's not discernible, you're chasing your tail.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 slightly softer here by 0.1%. You saw the headlines yesterday within striking distance of 5K on the S&P 500. Bramo just waiting and waiting and waiting within 5 points at a close of 5K.
And it's not coming with exactly this rip-roaring feeling of bullishness and conviction. It's coming with the sort of like, all right, I guess the Mag 7 are going to keep on doing their thing. We'll go into them. We're going to hope for it to broaden out a little bit. We're not going to bank on that, and maybe we can get there. I mean, it's not exactly like people are just screaming, yes, let's go.
This was a big feature of the conversation yesterday on the program, standing on the shoulders of fewer and fewer stocks. The Mag 7 becoming the saying this is about locking in rates. Well, they get another opportunity to do just that a little bit later. 30-year supply. That number, $25 billion US. Are we comfortable with the size of the deficit in the United States?
By we, who are you talking about?
Not you.
If you look at the Congressional Budget Office, they came out with their projections yesterday. Interest expense. I mean, again, I go back to PICTOL, the toggle bond, payment in kind junk bond, where basically you borrow more money to cover your interest payments because you don't have enough in terms of the revenue. That's essentially the U.S. government. You're talking about interest payments that are now exceeding the cost of defense spending in the United States this year for the first time.
Net interest payments climb 3.1% of GDP, highest going back to record since 1940. This is concerning.
It's insane. So we can rely on people down in Washington, D.C. to fix this. Let's talk about the leadership, the race to be the president of the United States. So the former president is confusing Nikki Haley with Nancy Pelosi. The current president is confusing French leaders, and overnight he's now confusing
German leaders.
Yeah, that's right. This is another episode of the president confusing European leaders. It comes over the weekend. Let's map this out. Over the weekend, he confused Emmanuel Macron with Mitterrand, which got a ton of blowback in French press, by the way. And then last night in New York at two fundraisers, he was telling this story yet again of his time at the G7. And instead of saying it was Angela Merkel that looked to him and said, can you imagine this happened at the British Parliament? He confused it with Helmut Kohl, who died, Jonathan, many years ago.
He's not just confused in decades, Bramo. These people are dead. They're not here anymore. It's insane.
You want me to comment on this?
Please do. I think it's important.
Okay. This raises this question of what's the bar right now? I go back to what Jim McKelvey said yesterday.
Yeah.
You have the Democrats with a front runner who is the least likely to win against Trump, and you have Trump who is the least likely to win against Biden. You have two unwanted candidates going face to face, and now it's just a race to the bottom, and we get to experience it for a whole more 9 months or whatever it is.
It is a political marriage. They're married politically in order for both of them to be able to stay in this race. One thing I would say, when we conducted our last iteration of the Bloomberg News Morning Consult poll, people can write in things they like about individuals or candidates. For Biden, I'm looking back at some of these responses. Democrats are saying things that are very concerning about his age and mental acuity. When you have episodes like you had yesterday in front of peers, people who want to give him money, that is when it's going to really start to become very concerning.
We'll talk about the political mess down in Washington a little bit later on the program. The broader price action looks like this morning. We're down by 0.1% on the S&P 500. Equities a little softer. In the bond market, yields just a touch lower. On a 10-year, 4.1172 on a US 10-year. Coming up this hour, Ben Laidler of eToro with the S&P 500 on the verge of 5,000. Anna Ashton of Eurasia Group as deflation deepens in China. And Geetha Raghunathan of Bloomberg Intelligence as Disney looks to turn a corner. Let's talk about Disney in the pre-market. Lisa, up by something like 6%, turning a corner. All right, cutting costs. That stock is up by 6.6%.
Cutting costs, really trying to boost the cash dividend. And this is a story we've seen with big tech and others of how to attract people. I also think it's back to the future again. Moana 2. We're talking about, the issues.
There's a lot of examples of that at Disney.
But that's my point. It's sort of, going back to the tried and true and saying, all right, come on back, and everyone's singing Moana, and you go to the theaters. But it's, basically breeding nostalgia.
Hugh Johnston, formerly of PepsiCo, now of the Walt Disney Company, the CFO, coming up a little bit later this morning. We begin with our top story this hour, the S&P 500 on the verge of 5K. Ben Laidler of eToro expecting the rally to continue, saying this: lower inflation and coming interest rate cuts will drive an investor rotation from 23 US and big tech winners to rate-sensitive losers. Ben Laidler joins us now for more. Ben, let's get into it. Striking distance of 5K on the S&P 500. What's going to lead to that broadening of this rally away from big tech?
Maybe a little bit of time until we get interest rate cuts and until we continue to see this idiosyncratic earnings recovery. I think those are the two drivers for new highs for the S&P 500 and frankly for global equities. But also, the further we get into it, right now we're talking about rate cuts, we're talking about earnings acceleration. Later in the year, I think we're actually going to be seeing them. That is, I think, the trigger for the rotation from these crowded and justifiably very expensive and well-performing big tech names, frankly, into everything else, which has lagged and is a lot cheaper.
At the same time, Ben, there has been some weaker than expected performance in certain pockets of equity earnings, and we've seen that at a time where it's unclear how much the Fed is going to cut rates. Does this make you rethink some of your bullishness?
Not really. I think we maybe recalibrate a little bit where we expect to make the returns. So I think we've had a little bit of a pushback from the Fed on the pace and extent of the rate cuts. So maybe we make a little bit less on the valuation side. But I actually think, with the economy growing as strongly as it is right now, with the productivity boom we have underway, and with, earnings right now, 80% beats, running at 8% up, so better than last quarter. I think the earnings story actually is looking a little bit better, running a little bit ahead of schedule.
I love speaking to you, Ben, because you talk about how the Fed put us back and we all said, no way. And then everybody followed on and said the same thing. You were talking about being bullish and everyone said, you got to be cautious. You were right. Now you're going full bull in some of your notes where you're talking about the potential for buying European real estate, broadening out. Is this a now trade or is this a later trade when you start to get some conviction around some of these other themes?
I think it's a later trade that you get ready for now, A. And B, I don't think there's too much risk to being early. I don't think, I don't think there's anybody on the planet that knows that European real estate is not a troubled, cheap, depressed asset class right now, or more broadly Europe. Double-digit earnings declines, in recession. I mean, the bad news is out there. We just may need to wait a little bit for the catalyst to really, come through. So, do the research now, dribble some money in now. But I think for Europe and more broadly for, markets, I think the differences from last year will be, it'll be a little, we're annualizing a 35% return to the S&P 500 right now. I don't think we're going to see that for full year. So I think, a bit of a slowdown, back-ended returns, but broader returns. Because again, right now, this is a one-legged, Mag 7 stool. I think it, broadens out later in the year.
Ben, these rent-sensitive losers, can we talk about them a little bit more? Not just real estate. Is it the banks as well? Because I look at the regional banks and they feel like rate-sensitive losers over the last year, not the winners we'd expect them to be.
Yeah, absolutely. I mean, there's plenty of risks out there, commercial real estate, small banks, China. I guess the point I would just make, these are the sort of, the most talked about, slowest moving, train wrecks in history. Policymakers, everybody's all over that, I think. And I think it's well sort of discounted in markets. So, I'm looking at these sort of cheaper, more discounted sectors. So that can be real estate, but it's also basic materials, industrials, and partly financials. That's the biggest sector in Europe. But there's also a big regional component to this. It's everything outside the US, where these more cyclical sectors are just much more heavily weighted. They don't have these big tech sectors. So it's Europe and, dare I say it, under my breath, China.
Well, let's talk about China. The data overnight. It looks like deflation is deepening. It looks like China wants to deal with the symptoms to try and support the stock market without dealing with the underlying problems. Ben, how can you be optimistic on what's happening there right now?
Yeah, so I'm not overly optimistic, right? I think, if you want to play that cyclical global rotation trade, I think Europe is the place to go rather than China. I think, the risk is China's a value trap. The economy's up 15 times in 25 years. The stock market's flat. So history's not on my side. But 8 times earnings, extraordinarily depressed, investor sentiment. The authorities, yes, they may be beginning to deal with the symptoms rather than the underlying cure, but at least they're dealing with something. And fourthly, let's not forget, this is very much a self-inflicted problem. They decided to crack down on the over-indebted, property sector. They could easily wake up tomorrow and decide to be a little bit more forceful. That makes me, moderately positive, but risks are clearly higher in China than they are in many other markets.
Well, Ben, what would you want to see out of China? Because we've seen them try a number of things to prop up the market. It hasn't exactly worked. What would you actually want to see to become more optimistic?
They have some of the highest real interest rates in the world. I think they should be cutting interest rates, quite frankly. I think they should be more forceful of the property market. I think that's one of the underlying causes of the consumer weakness. I mean, there's 3 drivers of this Chinese weakness: the property sector, the weak consumer, and the global manufacturing recession. They can't do anything about global manufacturing, but I think they can definitely do more about the first 2. They have the policy tools. They have the policy, flexibility. They should be, pulling those levers, a little bit more. And again, I think a little bit of good news could go a very long way, given how cheap, depressed, and out of favor, Chinese stocks are.
Ben, can you be even moderately bullish on China and also believe in the disinflation story?
I don't really believe the disinflation story. I think you dig into the numbers. I think this was probably the worst month for disinflation. We've had 30% declines in pork prices. I don't think any of that's going to be repeated. So
I mean globally, Ben, I mean globally. The disinflation story for Europe, the disinflation story for the US, the commodity-driven kind of disinflation that a lot of people are celebrating.
So I think that's a given. I don't think that's gone away. I mean, what I'm focusing on is the productivity boom. And that is what's driving this immaculate disinflation, we're seeing globally. There's a real question mark as to whether that's going to continue. But, right now we're seeing it. And I think you can make the argument that maybe it does, that this sort of productivity paradox we've lived with for a long time is beginning to end. And if productivity can continue to grow at at twice long-term average levels, which is what it's growing on in the US, then I think we can thread this needle and company profits will benefit handsomely.
Ben, always constructive, optimistic. It's good to hear from you. Ben Laidler, of eToro. Great to catch up. Ben was one of the first to come on the show last year and talk about the return of the Fed put, which sounded really, really foreign at the time because we hadn't heard it for about 2 years. But he was right. The Federal Reserve, based on what we heard from Chairman Powell just last week, is willing to step in if things deteriorate and isn't afraid of strong growth. They're willing to embrace it. That's a change.
This, to me, is a reason why you're still pricing in more than 20% chance of a March rate cut. They basically all but told us you're not going to get a March rate cut. But the fact that people are still expecting it means that there's some sort of boogeyman lurking out there that they think could rear its head and the Fed will come in.
And also the fact they're pushing back and we're still talking about 5K on the S&P 500. Correct. We have pushed back expectations and stocks are still doing all right. We're doing okay this morning. We're down about 0.1% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel and the U.S. are split on a proposed response by Hamas to pause fighting and release dozens of hostages. Israeli Prime Minister Benjamin Netanyahu rejected the proposal. Meanwhile, U.S. Secretary of State Anthony Blinken told reporters Hamas's response, quote, creates space for agreement. The U.S. has sought to ease the fighting in the Middle East since Hamas's attack on October 7th. Connecticut Governor Ned Lamont has unveiled a plan to challenge New York State's rule for taxing remote workers. New York requires workers to pay income tax to the state if their job is based there, even if they work remotely outside state lines. The governor's plan for his part encourages residents to file suits against New York in order to get tax refunds. Lamont says the proposal could generate over $200 million annually if successful. Apple's limited release of its Vision Pro headset is prompting a hefty resale market. The $3,500 device is only available in certain U.S. stores, and overseas resellers are charging a chunky premium. Some are going for more than $5,000 rather. That's the right amount. Apple has limited the rollout of the new headset in order to accommodate the elaborate setup and customization process for each buyer. That's your Bloomberg Brief. John.
Danny, thank you. Thank you very much. Let's pause. They are the masters at this, to create scarcity. And all of a sudden you're thinking 3,500 is expensive. Now I'm anchored at 5. So 3,500 sounds like a bargain when it's available. Apple, I'm not sure if they do this deliberately or not. It's not for me to say. I've got no inside information on that. But I'm just saying they are the absolute masters of creating scarcity that may or may not exist.
You know what this reminds me of?
What's that?
Sneaker drops. This, to me, reminds me of the flipping that happens with sneakers. And it's sort of, limited edition. You can get these, then sell them. That's, a similar kind of playbook.
One individual in Singapore is selling it for $6,300.
That's nuts.
We should have been buying them up, waiting online, and then reselling them in
And when you
markets.
start to get supply, what happens? All of a sudden, that's what I'm talking about. 3,500 feels good. Shouldn't feel good, but it starts to feel better relative to what's happening in the so-called secondary market.
It's also, who are the buyers? It's people who want to be ahead of things. It's people who want to be gadget folks.
Hardcore gamers.
Yeah. So.
Okay, that's enough of Apple. More on that a little bit later, maybe. Up next on the program, a fight over the border preserved for the presidential election.
Americans are ticked off that this is not resolved, and they expect us to get things done. So why don't we do that?
That conversation is coming up next. You're watching Bloomberg TV.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
The stock market very, very close to 5K on the S&P 500 at the close yesterday. Equity futures pulling back just a little bit. We're down 0.14% on the S&P. Yields doing nothing, 411.92, really decent 10-year auction yesterday. Yields this morning, unchanged. Under surveillance this morning, a fight over the border preserved for the presidential election.
Less than 24 hours after we released the bill, my Republican colleagues changed their minds. Turns out, they want all talk and no action.
Americans are ticked off that this is not resolved. And they expect us to get things done. So why don't we do that?
So why don't we? Here's the latest. Senate Democrats promising a vote today on a standalone bill to deliver aid to Israel and Ukraine. It comes after the GOP killed an attempt to combine border security and international aid. Ed Mills of Raymond James suggested the strategy may not pay off for Republicans, writing this. The border deal is a classic example of wanting to keep the issue versus solving the problem. But the defeat of the border bill is adding to the complication for everything. Ed Mills joins us now for more. So Ed, as we know, and welcome to the program, sir, as always, as we know, it's the president that's taken the blame on this issue. He polls really badly on it. Is there any reason to believe that changes in the weeks and months to come after the debacle of the last couple of days?
Well, clearly, John, both sides are going to be positioning for the upper hand on the fight related to the border. There's a lot of polling that suggests that this election is going to be kind of on domestic issues such as inflation, the border, geopolitical risk. And for Republicans, and the reason why I wrote that is that for Trump, the border is kind of core to his strategy to win this election. As a Republican, why would you kind of take away or reduce the strength of that fight? And for folks like Senator Langford, who had a really good attempt here at getting a deal, he learned a lesson that in politics, when you're explaining, you're losing. And so his base did not want this bill because they didn't want to take away the issue. They want to put a lot of pressure on President Biden. Biden certainly kind of does not want to kind of have this as an issue going into November. There's going to be a lot of pressure on him for executive action. But the politics here, they're swinging widely. And I think it's a little too early to say exactly who wins, but the pressure right now is going to be on Republicans to explain what happened with this bill and for Biden to explain what's happening with the border.
Ed, with that as the background, how do Republicans then sign up for foreign aid to Taiwan, Israel, and Ukraine when they said we are not going to sign up for another dime of foreign aid until we have a border deal?
Well, right now, Plan B is going back to Plan A. And there's still a strong support of military kind of aid to Israel, to Taiwan, to Ukraine. But again, it's into this kind of when you're explaining, you're losing. So the backup strategy is to do this defense-only bill. That was getting a vote last night. It went into overtime. They don't have the 60 votes in the Senate just yet, so they're going to reconvene today at noon to see if they can get one or two more Republicans on board. You're actually going to give them more amendments to go on that bill to get them to that 60 votes. And those amendments, guess what? They're probably border-related provisions. And, you know, in the House this week, we had a vote to have the impeachment of the HHS secretary, had a vote on an Israel-only bill. Those bills both, you know, failed. This just shows just the toxicity that's going on these issues right now in D.C. And there's real market impacts from the kind of defense sector, what happens with folks kind of tied to border security. But I'd also just take a step back and say, as D.C. remains in chaos, markets are hitting new highs. So make sure we don't get too much of this kind of chaos in DC into our kind of thinking as it relates to the broader market.
It's astonishing to wake up and see the Republicans are struggling to get this over the finish line when the minority leader is a defense hawk. How diminished is Mitch McConnell's role right now and power in the Senate?
Yeah, that's a really good question, because I think what we're seeing here is Mitch McConnell, who we always could vote, kind of be certain that he knew exactly where his caucus was, where the votes are. He's really dismissed or kind of moved away from former President Trump and his caucus as they are kind of getting ready for Trump as the nominee and the head of the party once again, are moving away from Mitch McConnell. And so kind of what Mitch McConnell wants versus what his caucus wants are increasingly two separate things. Is he going to be the leader by the end of this Congress? I don't know. Is Johnson going to be the speaker by the end of the month? I don't know. So when we have any bipartisan deals, the word you should be watching is uniparty. Anything that's bipartisan is being viewed by the Republican base as uniparty. That means kind of the folks in DC are not with the rest of the base, and that gets really hard to support. Bipartisanship is a four-letter word right now in DC.
And it's amazing. Let's talk about the future. It's clearly a mess down in Washington, D.C. And if you're looking at this country at the moment and you're hoping there's a different way, a different set of options, let's compare the two on the table going into the election in November. We've got one leader, the former president, who is confusing Nikki Haley with Nancy Pelosi. We've got another leader, the sitting president, who is confusing European leaders with deceased European leaders from different decades. Ed, what is this going to look like? Not in 2 months, but in 6, when this really picks up.
John, I think that those are kind of important, especially in the political context, but I kind of try not to get into too much of kind of misquotes kind of on a campaign trail versus what are the real policies. I'm focused much more on kind of what would the policies of a President Trump be versus what the policies of a Joe Biden. That's when I get questions here at Raymond James, where folks are mostly focused on. So when we think about the future of this election, what people are focused on is what happens with tax cuts as they expire next December. What happens with bank regulation? What happens with all of these policies versus those individual statements?
Ed Mills of Raymond James. Ed, thank you. I guess what I'm focused on, Bramo, is their ability to orchestrate things down in Washington and actually deliver the policies that they're talking about, their ability to convey those policies to the electorate when they're campaigning.
Exactly to that point. We're not talking about those things. We don't know what their views are. We're not sure exactly what those policies are going to be. It's not getting any clearer because we're talking instead about all the other stuff, the politics of it, the mishaps, et cetera. And at a certain point, I get the sense that a lot of people on Wall Street are tuning it out until they have to pay attention. I get it.
If you're frustrated by this now, wait a few months. Wait a few
we're
months.
all excited for that. It's just warming up. It was a fundraiser
last night. The things we're talking about are going to get so much worse.
And they're serious. I mean, again, the CBO report yesterday really put that into the fore.
Anna Ashton of Eurasia Group is joining us next with pressure mounting on China to step up support. That conversation up next from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Stocks on the S&P 500 pulling back. We're down by 0.2%. On the Nasdaq, we're down by 0.2 also. The Russell negative by 0.5%, getting closer and closer to 5K at a close just yesterday. We'll talk more about that a little bit later. Let's talk about this bond market, the 10-year. Supply went pretty decent yesterday, $42 billion of 10-year treasuries. Pretty strong. That's a record for a 10-year auction. Yields lower than what we anticipated. The 30-year a little bit later, $25 billion worth, at least at a yield this morning, 434.16.
And it comes in tandem with the market bringing down some of inflation expectations over a longer term. The stability in the bond market is notable to me, given that a lot of people are talking about the risk of reinflation later on this year. It's not showing up in the auctions, so we can just not care about them until they do.
Move on from treasuries until it starts to matter. Maybe it matters this afternoon. Let's finish on foreign exchange. There's a new number that I keep hearing. It's 105. Heard 105 from Jane Foley of Rabobank yesterday, looking for the euro to drop from 107 to 105. SocGen's Kit Jukes this morning. Lisa talking about the same number, the prospect of dropping to 105.
So basically this conviction for a bit more dollar strength, but not that much, not the bold, crazy parity calls. This is sort of this slow-moving train. Everyone knows the U.S. is doing a lot better than Europe. Now it's a question of when you start with the rate cuts and also what has been priced in. And I think that the strength of the U.S. hadn't been fully priced in relative to the ongoing weakness in Europe.
And we had a ton of easing priced into markets for the Federal Reserve. Then the Fed started pushing back against that, and that pushback is reinforced by the data. The economic data has been pretty strong. So Kit says this: if the market embraces the idea that the Fed's projection of 3 cuts this year is in fact what's going to happen, the dollar's got something like 2 to 3% upside, which isn't a major move, Lisa, when you think about it. 2 to 3% down from 107 to 105 on the euro.
It's kind of going back to what Ben later was saying. We basically have all of these knowns out there. It's just a question of calibrating what's priced in and how to sort of re-risk some of the issues. And that's kind of what you see going on with this currency pair.
The euro just a touch weaker on the session. Under surveillance this morning, your top stories: U.S. forces killing the commander of an Iran-backed militia group with a drone strike in Iraq overnight. The Pentagon claiming the leader was responsible for directly planning and participating in attacks on U.S. forces in the region. The U.S. military vowing to continue its response to paramilitary groups and Houthi rebels after a deadly attack on a U.S. base in Jordan last month. AMH, that effort continues.
Yeah, it does continue, but we heard from Kataib Hezbollah, and they said on Telegram that set your clocks for revenge time. So it does look like our forces in the Middle East are going to be on guard for what is going on, the constant, also what's going on in the Red Sea. This is a little bit different. I took away from this strike the fact that this is not the United States just degrading Iranian military proxy capability. This is actually a response to those 3 service members that died in Jordan. And also, this will serve as a deterrent. We know where your personnel is, and we have the ability to harm you.
Honestly, to me, I just start thinking about some of the corporate blowback. The fact that Immerse came out and talked about how this is not, we haven't even seen this peak, that they've seen ongoing attacks on their ships, that they actually expect a much lower outlook for the year as a result of it. The fact that because of the ongoing conflict, we saw sales at McDonald's and Starbucks fall off a cliff. This is having real impact on specific companies. And that's really what I'm watching as this sort of continues.
Let's talk about Immerse right now. This used to be one of my favorite companies, CEOs to interview when we were based over in Europe, just to get insight on the global economy. To Lisa's point, attacks on vessels in the area in the Red Sea have pushed rates higher, but shipments have been dramatically slowed, with carriers taking the long route around Africa. The CEO telling Bloomberg this morning there is no clear timetable as to when and how the international community, Lisa, will be able to guarantee safe passage. That's what they're confronting right now. This stock was doing well at one point off the back of maybe higher rates, but ultimately this morning it's down hard by 16%.
And they were talking about how this could go on for another year. And I don't think that they would want their shares to plunge by 15% and just be sort of, cavalier about making some of these projections. So if that's the case, you have to wonder about other broader implications on a macro level, because right now people are kind of watching this as a possible tail risk. You're seeing it actually come into the numbers, and I really do think that that's important.
That stock is lower this morning. Let's talk about a name that is higher, Disney, the Walt Disney Company. CEO Bob Iger saying the company is turning the corner. The company beating earnings expectations thanks to cost cuts and performance in international theme parks. Subscribers to Disney fell in the last quarter, but Iger forecasting that streaming will be profitable by fall. Disney also spending big on gaming. How about this, announcing a $1.5 billion investment in Epic Games? The stock is up by 6%. We'll catch up with the CFO, Lisa, later on today.
So some of the key questions here is, A, the sports bundling sort of effort, how that's going to play into all of this. B, where some of the growth is going to come from, because you do not see the streamer subscriber growth coming there. So where are they exactly going to push this, given that they've tried to raise prices and they've increased profit margins there? And then C, are we ever going to see new characters, or is this all nostalgia? I'm serious.
Growth is coming from one, they're trying to tap the star power of Taylor Swift, which also politicians in Washington, D.C. are also after. But two, I'm confused about Disney going to be announcing an ESPN service in 2025. What's the difference between the ESPN streaming service and the bundle that they're getting behind?
I got a lot of questions about that. I've got questions about this as well. This is one of the poster charts for American Inc. Now, Starbucks got hit, McDonald's got hit, Walt Disney theme parks still doing okay? That's a curious one, isn't it?
Yeah.
Internationally, why are they doing okay and the others are struggling in the face of U.S. foreign policy?
Yeah, why is Zootopia in Shanghai a bright spot for them? I mean, really, this is a key question. I'm glad that you brought this up. How long can they continue to bank on that, given the fact that China hasn't been very friendly to U.S. businesses, and how come it has been so immune?
Let's turn to China. Consumer prices falling at the fastest pace since 2009, adding pressure on the government to step up support. Anna Ashton of Eurasia Group writing this: the bias towards control and security-oriented policy coupled with a lack of clarity on policy direction will weigh on confidence and disappoint expectations, further entrenching a sense of economic malaise. Anna Ashton joins us now for more. Anna, you're right on the money. This is where we've been focused on the last week, the last month, why they're so preoccupied with the price of stocks and not the underlying issues. Is that going to change, Anna, anytime soon?
Well, first of all, I have to say that was my colleague's writing, but I agree that she's right on the money. And, I don't think that it is going to change anytime soon. The reality is that the government is not prepared to respond with stronger stimulus measures. It's not clear what kinds of stimulus measures would really do the trick of boosting consumer demand anyway. And there is this continued tension between emphasizing national security and emphasizing economic growth. It creates confusion for businesses, and it also isn't helping the continuing weak consumer demand.
There have been also some surprising personnel shifts recently, Anna, including the recent firing of the head of the nation's security regulator in the wake of the briefing that Xi Jinping got. They appointed a new person, a 58-year-old market veteran. What do you make of this? Some of the personnel shifts, the abrupt changes that have come on the heels of some of these market moves?
Well, I think, a personnel shift signals that there's a fall guy. There's somebody to blame, and if that person is gotten rid of and somebody new is brought in, then things can get better. But the policy direction overall, the signs about the policy direction overall aren't yet indicating that things can get better in a significant way. This person does have a considerable amount of experience. Wu Qing is his name. And it could be that he brings in a policy direction that does help. But again, the focus on national security as opposed to economic development and growth makes that really difficult.
There's a real question about what's behind some of the weakness. People are talking about idiosyncratic factors like pork prices. Other people talking about international trade, especially as the trade deficit in the U.S. fell quite considerably yesterday in data that came out. How much is a diversification away from China by the U.S., by Europe, part of what's behind the weakness?
I mean, I do think that that is a fair thing to point to, because we know that there's been weak hiring in the manufacturing sector, and weak hiring leads to weak income growth, which leads to weak demand. But it's not just the manufacturing sector that has had weak hiring. It's also the services sectors, it's the construction sectors. So it's bigger than just the lack of demand from developed markets that normally would be spending more on Chinese imports. I think also, there's the fact, of course, that there's a weak property market, and the property market contributes about 10% of China's GDP. There's not anything, any sector that really can fill in that gap, and there's no chance of the property market rebounding to what it was before.
Anna, we have just wrapped up meetings in China between Chinese officials and U.S. officials, this working group. They're talking about a number of things, tariffs, two-way investment restrictions, sanctions against Chinese companies. Do you expect anything to come from these meetings?
I think the meetings themselves are important. The communication is important. What will come from the meetings, that's a little bit harder to tell. I think that the meetings do help to signal from one side to the other what the major issues are. And we know that the U.S. side has been raising industrial policy in China as one of its issues. The economy is heavily reliant on industrial policy today, more so than it was pre-COVID. And that is raising concerns in the United States and elsewhere about overcapacity and potential dumping of things like Chinese electric vehicles onto the U.S. market and other markets, undermining the ability of those markets to develop their own domestic industries in those sectors. And I think that this is going to continue to be a problem because, of course, this is one of the ways to generate jobs and get consumer spending again, is to throw money into these emerging strategic sectors, but it also has negative trade implications.
When you look at potentially the upcoming U.S. election, and it's going to be Biden or Trump most likely, how does China preparing for that? Because I actually heard one analyst say that China is more concerned with Biden because he takes a multilateral approach against Beijing, while Trump just goes for a Beijing versus Washington. What is your take on that? Who is China actually more concerned about?
So this is a really interesting question, and I don't think that we know the answer definitively as to who China is more concerned about. I don't think that there's a clear answer as to who China would prefer, although there's lots of speculation around that. It is fair to say that Biden has taken a much stronger multilateral approach. That's been much more of an emphasis for him during his, 3.5 years in office, or 3.25 years in office. But that doesn't mean that Trump wouldn't take a multilateral approach. He certainly was pretty unilateral in his approach to the trade war at the beginning of his administration. But if you look at the second half of his administration, there was much more of an emphasis on reaching out to partners and allies to coordinate things like export controls. Particularly the effort to try to discourage allowing Huawei into different countries' tech infrastructure. It's possible that the Trump administration would pick up somewhat from where Biden left off with the multilateral alliances that have been built and fostered, but it's not a certainty. On the other hand, a unilateral Trump is not necessarily an easy Trump for China to deal with at all. Just because he makes other nations upset with his trade policy and is putting America first, so to speak, doesn't mean that he's predictable or easy to negotiate with. So I think it remains to be seen. I guess we'll see how the election pans out.
Anna, before we get to that election, I'm just wondering, what advice are you giving companies right now trying to operate in China? I'll pick out an example, say Apple, in the last couple of weeks, struggling in China. One part foreign exchange, one part increased competitors on the ground, but also there's a sense of rising nationalism in the consumer that's maybe pushing back against foreign brands. What's your advice to those companies operating there?
I mean, every company that has major operations in China and cares about being able to compete effectively in the China market, but is dealing with the geopolitical realities that are not going to change anytime soon, the tension between the United States and China, is diversifying and trying to make sure that they're not overly dependent on China. That takes more time for some industries than others. It certainly is taking more time for Apple than it would for a company with a simpler supply chain. But I think the reality is that if you want to be a successful company globally these days, you still have to be successful in China. And so most of those companies are trying to stay in China in order to compete there, the in China for China policy. And there's no reason to tell them not to at the moment.
Anna, appreciate it. Anna Ashton there, if you raise your group on the latest in China. Lisa, it's getting harder to do that, not easier.
And this is part of the problem, especially with the election coming up and especially with some of the uncertainties. This is why I'm curious what Disney has to say about that.
Disney CFO coming up a little bit later this morning. Let's get you an update on the top stories elsewhere today. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares in PayPal are lower in the pre-market trade. The company forecasts little profit growth for the full year. The company's disappointing first quarter and 2024 outlook overshadowed fourth quarter earnings that did beat estimates. PayPal announced last month that it's going to cut 9% of its workforce as it continues to trim costs and streamline operations. Disney announced it's taken a $1.5 billion stake in Fortnite maker Epic Games. The deal allows a video game maker to use popular Disney properties like Star Wars, Marvel, and Avatar. The collaboration marks Disney's biggest